Good morning and welcome to Trade Live with IG, with myself, Rich McDonald. And we got Tom Robertson this morning, the king of the PCMs.
That's not true, and you know that. Good morning, Rich. How are you?
How are we doing? We have got a very interesting set of developments over the weekend to talk about. The first coming late Friday night. So we're going to cover that debt downgrade in a second, but let's look at what is coming up on today's show, people. Right, we've got some overnight action with myself and Tom Roberts up to 8:35. Then we've got Matt Arbour coming in to chat with Angeline. And then as soon as the guys press the button, we go on to the next page, which they're always a little bit slow on. We get trade expectations with Martin Harris at 9:20 with Ange. And then Axel Rudolph, we got both trade of the week and technically speaking. So get your questions ready for that. David Boyce front running us with the information here. Will it be a moody Monday? It's certainly looking that way so far. Tom Roberts, do you want to tell me some interesting stories about your weekend before we get into moody stuff?
No, good weekend. As I said, quite tiring. We had a fundraiser Friday night for our local rugby club, Stamford Rugby Club up in Lincolnshire. Trying to raise some money for a new roof and for the community kids, the sort of 12 and under grassroots kids, which was good fun. Cricket Saturday, lots of fun there. And then watching the mighty Quins yesterday for Danny Kerr's last game.
Result?
A very, very small win for Quins against Exeter.
I mean,
by a couple of points.
We're talking about Quins on a weekend where there was one of the biggest finals in history.
Crystal Palace?
The Eurovision Song Contest.
I mean, just don't. That is just awful.
I'll tell you say that right, but
didn't we get 0 points again?
We got 0 points from
we were 19th. Like,
yeah.
Why are you even giving this airtime, Rich? Disgraceful.
Well, because Angeline spent the Saturday evening watching with her daughter. But even funnier than that, our producer has been on holiday in the sunshine. As you might have seen on Friday, he came on and did a quick cameo appearance. But on holiday, he spent an evening watching the semi-finals on television in his room.
That is commitment. Commitment to the cause of Eurovision. I'm not sure I'd do that on my holiday, to be honest.
Yes. Anyway, right, let's get into it then, people. Let's go into some overnight action and we'll have a look at where these futures are trading. He says yes. He says that it was that, or basically the equivalent of a school disco, because that's what happens if you go to one of these family hotels, Phil, without a family.
All looks a bit red this morning, doesn't it, Rich?
It does look a bit red. Run us through why that is, Thomas.
I mean, quite a bit going on this morning for the viewers out there. They may have seen a couple of things over the weekend. One, obviously, a downgrade to the US rating by Moody's.
Which came out late Friday, didn't it?
It did. It was downgraded by Moody's to AA minus rather than AAA.
Mm-hmm.
And Moody's are actually the last of the rating agencies to do that, but probably the most significant.
And that is a reason people are throwing it out and saying it doesn't matter. So I've just got something up to remind people that just because one company did it back in 2011 doesn't mean that it doesn't matter now. Because in 2011, Tom Roberts, what was the debt at the US? 2011. What do we think the debt was? Federal debt. Do we want to have a little guess, people? So remembering now, it is $36.8 trillion for the history of the country since we went across there and liberated them. What year did we go across to the US? Sorry, I say we, it was the English.
17...
Yeah, of course, because it's in the musical, isn't it?
Yeah.
1775.
1775? I was going to say 1776, but okay, 1775. US debt. Rich, I'm putting numbers out here. I'm going to say 8 trillion.
So it was 8 before the crisis, or during the crisis, I think.
08, 09.
Yeah.
Okay. So 11 would be mid-teens.
We're getting some guesses here. Gavin Ackers, good morning to you all. Gavin saying 6, Monkey Man saying 4. Steve Davies going low. Low ball, Steve Davies, 2.5. 5 trillion from Boise, 8 from Wing It. Well, I have the 2012 number, right? So I am fudging it a little bit. So let's get the graphic up there. 15.2 trillion back in 2012. So I'm not quite sure what the jump was 2011 to 2012, but more importantly, the debt to GDP was 100%, right? Fast forward to today, and you can see it's ballooned to 36 trillion and 123% of debt to GDP. So it's a completely different scenario. Forget that they were downgraded in 2011. This downgrade matters. And it matters as well because the interest on the net debt is $1 trillion today. And back then it was only 227 million.
So, sorry, just having a quick look.
Billion, sorry.
Debt ceiling was raised end of 2010 from $14.3. This is obviously.
Yeah.
But your point on the interest is the more pardon the pun, the more interesting point. It's $1 trillion a year in interest, isn't it?
And growing.
That's A, not sustainable. B, and I'm slightly sticking my neck out here, I don't think that's recoverable. Not quite sure
Agreed.
how they can ever pay that back.
Yeah.
If people think about it in very basic terms, when your credit card gets too big and you're trying to pay off the interest and that's all you can do, it gets to a point where you can't even do that. And you have to get into negotiations about paying just part of the interest. And $1 trillion a year of pure interest payments against what they are receiving is starting to become unsustainable at a point. Now, that might not be this year, but certainly in the presidency it might be.
And people have to be aware of it. And that is what we're completely ignoring if we're trading on 22 times earnings. Completely ignoring this kind of thing. But the debt markets aren't ignoring it because the debt markets are starting to just say, hold on. You're trying to fudge the numbers again with your one big debt bill, Mr. Trump. And therefore, we are going to put your 30-year debt yield up to 5%. And we're trading at 5% on that 30-year. And the 10-year at 4.5. So despite the thought that there'll be a couple of rate cuts this year, that long end's looking particularly precarious.
And increasing.
And increasing. Now, even worse in the UK, of course, because the 30 years at 5.38. But, we're not nearly in the same amount of, we don't have a debt issue. We have a economic issue.
Yep.
Just keep, when you're throwing out the Moody's downgrade today as irrelevant, along with a lot of others.
Have a think about that.
And
also that second point about the debt in the US, I think that's why, Besant said over the weekend that countries will get a letter with a US tariff rate if they are not negotiating in good faith, in inverted commas. And he thinks the rate would be similar or the same as the second level. And they're counting a lot on these tariffs to receive the income that they need to receive, the tax credits. And that's going to help them eventually with the debt. But if people don't come to the party and they revoke back to these levels, the business just won't come into the US full stop at that point.
Yeah.
They'll just revert going, okay, it's too high. it's 90%, it's 80%. We're not interested.
So I actually think that's why the futures are down. If we just want to have a look at the futures again, 1.3% on the Nasdaq, 1%. But that's largely nothing. That's probably where it was on Thursday, right? Because we've had a massive markup Wednesday, Thursday, Friday. So I think that you're right. That's the more important story, is that tariffs on some countries are coming back after the 90 days. The final thing I want to point out on the debt, and sorry, just spot the volatility index back up 5% there as well. The one thing to pay attention to on the debt is what they're trying to do in this bill, right? Now, they've said, and the whole reason for Doge and the whole reason that Trump's doing things like the tariffs is to get a balanced budget.
Yep.
Now, what they cannot put through on this bill that's trying to go through this week, they cannot add to the debt pile. They cannot add and put the deficit out of whack. So they're trying to fudge the numbers, because taxes, the taxes that were cut in the original Trump 2016 that sent the market skyrocketing in 2017, right? We were up 20-odd%. Those tax cuts automatically roll off. Therefore, taxes are going up, right? What they're trying to say in the to get the bill through is, no, forget taxes were meant to go up. Let's just take it as if they were always going to stay the same. And so they're trying to segment the tax increases, and therefore what they actually are, they're tax cuts. They're trying to segment that out and say, no, you can't count that because it's already absolute bullshit. It is lies and lies on top of lies. It's incredible they get away with it. And so well done, Moody's, for doing what you've done.
We'll see how much attention's paid to it as well, and we'll see what comments, rhetoric comes out of the US about this, because they'll be asked about this week. Mm-hmm. They'll be asked, what do you think of the downgrade, etc. And they'll brush it off as, of course, not important.
As Janet Yellen did for 7 years.
As you said, when they do that, just think about certain parameters of why Moody's have done that, including the debt.
Yeah.
But the House Budget Committee is approving, or has approved, hasn't it, Trump's tax bill, and there's another vote this week just to get it through, I think, isn't it?
Well, they're trying.
Yeah,
that's going to
on
be
Wednesday.
Tricky. Yeah.
Another reason possibly for levels down a little bit this morning, first thing, I was on the train this morning, had a quick look at the China numbers.
You were on the train early this morning, weren't you?
I was indeed.
What time did that train leave the station?
5:10 this morning. It was a joyous 5:10. But yeah, China numbers a little bit weaker than expected. That's April retail sales.
So let's have a look at that economic calendar, since we're talking about it. Producer's back on holiday, I think. Economic calendar coming up. There it is. And take us through those numbers and what we got coming up today, Tom.
Yeah, so retail sales out of China raises to 5.1 year on year. The estimate on that, by the way, was 5.8. So it's a decent miss, that.
Yeah.
April industrial output as well out of China, 6.1 versus 5.7. Mm-hmm. We've got the inflation rate numbers come out of the UK. That's Wednesday, sorry, apologies. And home sales inflation rate, home sales for the USA on Thursday, inflation rate for Japan on Friday, and retail sales for...
Relatively quiet, to be honest, isn't it? We've got a few Fed speakers, but those numbers aren't... They'll move
the UK inflation rate is important on Wednesday to see where we're at. Don't think it's going to move the dial that much, but that one is important as well.
Yeah.
Also, Trump and Putin, I think, are having a call today, aren't they, this afternoon?
Yeah, first time in 3 months that they've spoken directly.
So obviously Ukraine will probably be the top of the order on that one, along with how negotiations will be proceeding going forward, and probably some military talk as well about military spending.
What do you think, as anybody does in a phone call, what do you think the first sort of, exchange of greetings are? How are the kids?
Hello, old friend.
Hello.
How are you?
Yeah.
What do you think of the football score at the weekend?
Yeah. How was your trip to Saudi there?
Yes.
Nice jet.
Yes.
Very nice jet.
I don't think Putin speaks any English, by the way, at all.
He says he doesn't. Of course he does. He was KGB. Allegedly.
Allegedly. And the UK, Luke Moore was discussing this morning, just saying the UK and the EU are expected to agree a sort of post-Brexit reconciliation today. I believe there is a informal summit at Downing Street today, this afternoon.
Yeah, so let's have a look at the front page of the Financial Times. And you see we got the story there. So they're agreeing the post-Brexit reset after breakthrough in talks, right? Now, this is a relatively dull story, but just wait until you hear what's coming, people. Every time you fly to Europe and you're forced to stand in that line with everybody else from anywhere in the world.
Rest of the world line.
The rest of the world line. No, not after this. Keir has done it for us. Keir has got us our own, along with the European Union, entry into European countries, which it ruins the start of my trip every time. I've stood in queues in Berlin for an hour.
Really?
With babies being sick because it's so hot. Yeah, so very, very happy about this.
Is there anything, jokes apart, is there anything meaty in there? I know they spoke about the fishing rights, haven't they? And
that's right. It's food, fish,
farming and fishing.
Youth mobility.
Yeah.
Yeah. So so we got that, and that's going to be all the headlines on your 6 o'clock news tonight. But yes, the other headlines. I saw Monkey Man come out. What were the comments about Walmart over the weekend? Of course, on Friday, Walmart said we're going to have to put up prices because that's what we do. We're a US company. If our costs go up, we put up prices by more than our cost to increase our margins. Trump said, no, eat it.
Eat the tariffs.
Eat the tariffs, Walmart.
Trump says Walmart should stop blaming tariffs for price increasing, suggesting they should, in inverted commas, eat the tariffs.
Brilliant. So I'm not sure if he understands, but, stock prices trade on margins. And if you're forcing the companies to eat the tariffs, then, at some point your stock market's meant to go down, in theory. But no, they just keep extending the multiple, don't they? Can you tell I'm in an especially bearish mood today?
You are, aren't you?
Right, front page of the Times. What do we have? We've got UF tariffs lead companies to save cash by rejecting invoices. That's gone up to 7% of all invoices in the States are now rejected. That's from 2% last year.
So that's saying reject the invoice either on an admin error or just reject it full stop to save your cash flow and kick it down, basically kick it down the line.
Exactly. And it's mainly, it was over April 2nd and to give a chance to, unknown what was coming.
Yep.
So then you'd have a chance to renegotiate terms.
But all you're doing there is kicking the can down the road.
Yeah.
For a short period of time. Okay.
Yeah.
I hadn't seen that.
That was Walmart. We've had, what else was in yes. Now, Unilever. Unilever announcing an 80 million fragrance facility near Liverpool. Do not mess with my Lynx Africa. That is, you can go with perfumes and you can do what you want there, soap even. But if you start to threaten to take Lynx Africa off the shelves again, I will not be happy.
You're beginning to sound like Alan Partridge now with his Lynx.
Aha! Great story between him and Liam Gallagher. I'll leave that for another occasion. Right, what else? Well, numbers. It's quite a big week for numbers this week. So let me take you through. First of all, in the US, we've got Home Depot and Palo Alto tomorrow. Then on Wednesday, we've got Lowe's and Target. And then on Thursday, we've got Ralph Lauren, of course, amongst a host of others. But those are the kind of highlight ones. And it is going to be focused on the consumer.
Yeah. Yes, indeed.
UK,
there's a few as well.
UK, we got Vodafone tomorrow. Big set of numbers, huge.
What are you thinking on that?
I'm a bit nervous. So my bullish Vodafone call was from the CFO being very just generally optimistic and positive on the German turnaround.
Yep.
Well, he's off. He's resigned. So, you know, I'm worried that German turnaround is not happening. However, not happening yet because, of course, we've got the huge debt brake has been released in Germany. So it will come. And, you know, infrastructure, telcos as being a part of that, it will benefit. So what I'm really looking forward to is if they're down 5% tomorrow, maybe 3 to 5% tomorrow, and I get a chance to close my short and then sell some more puts.
Closed at 71.2 on Friday.
Yeah.
I know it's only 7:51, Rich, and there's 9 minutes of the auction, but it's been called down 4% at the moment. 68.3.
No, I don't think that's.
I don't think that's going to happen.
Just an early number. So yeah, then on Thursday we've got JD Sports, we've got SSE, and there's one other on Thursday. One other important one, cannot remember. But this morning we have had Diageo already. So let's take a quick look at what Diageo have said. Of course, they're going to mention tariffs, aren't they?
I've got a headline here of third quarter organic net sales beat estimates. It is maintaining guidance at the moment. Let's have a quick look into the numbers.
Yeah, so forecast 150 million annual hit from Trump's tariffs and launched a $500 million cost savings program. Let's see how that gets taken. 5.9% rise in Q3 organic sales and affirmed its full year forecast.
Yeah.
I think that will be a relief to many with that kind of hit.
One as well for the Open is Ryanair have warned this morning on the tariff war is basically their top threat to growth for this year. They've announced a share buyback of 750 million euros.
He loves a moan, doesn't he?
Michael O'Leary.
This morning he was saying that the screen off, thanks guys. He was saying the Brexit was the worst decision in political history. And he said if not inclusion, what was the word? If isolation was an economic ideal, then North Korea would be the richest country in the world. So yeah, he was.
Good line.
So let's see how Ryanair are going to trade on the off. We'll be watching that one. So that's we've covered the US debt. We've covered the earnings this week. What we haven't covered is people liking and subscribing. We've got, let's see, what shall we set the target for the week at, people? Monkey Man, we'll let you decide. We are currently at 664 subscribers. What do we think we can get to by the end of the week? It definitely starts with a 7, but does it start with a 7 and a 5?
I think it does.
Well, that's going big though.
I think it does.
Right, let's go. 750 targets. So if you're watching at this moment and you're not subscribing, if you're on the app and you've got a spare few minutes to come out of the app into the YouTube, please subscribe for us. There you go. Monkey Man's called it. 750 subs.
Correct.
That's a big week. Big week. Let's see,
Rich,
Ben.
This Monday negativity, this bearishness, it can't happen. You got to be positive. Shoot for the stars. Come on, 750. It's an easy number.
No.
I'm going to get my team to be making calls to every client to go and subscribe and like.
Oh, hello. There's a
I'll
promise.
put it out there.
Right. So therefore, every PCM call this week is going to include a mention of, by the way, have you watched myself on Trade Live with IG?
Or even better looking people of Luke Moore and Ronnie. So
That's right, because Ronnie's back on Wednesday.
Ronnie is back on Wednesday. Luke's around this week.
We got Piers in tomorrow. But notice we do have Ben Buswell back on the chat, and he's asking for another 100 payoff. I'll tell you what I've got on today. It's not quite 100, but if we can just get the screen up. I am long some puts, so £30 a point, $30 a point, sorry, of the 5875s on the S&P 500. All right, they cost me 13.6, and then I'm short 3 times as many, so it's a little bit risky if we collapsed. Short 3 times as many of the 5,800s. So therefore, it's a put ratio, that's called, right? A 1/3 or a 30/90, whatever you want. And I received 7.5 in total for selling those lower puts. So 13.6 minus 7.5, I am looking at, I've paid 6 points for 75 of downside. I don't think we go lower than 5,800 today.
Not by the end of the day, unless Trump and Putin say something outrageous.
True.
But
so there's a 12 for 1 payoff. Not quite the 100 for 1 payoff, but yeah, 12 for 1. Be careful when you are trading options. If you haven't traded them before, be especially careful. So there we go, 7:56. I can see the subscribers coming in already. Drop us a like as well. We're going to have a quick 2-minute break. We'll be back for Tom Roberts ringing his bell.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Bring me the next shiny new thing. Bring me the next shiny new thing.
All right, welcome back. Boise just asking, the expiry date on those options are 9 p.m. this evening. So it is the 0-day DTEs. So a little bit risky there. Oh, we got another one, another risky one coming up this week, but it's really interesting. We have found the British MicroStrategy. So we're going to chat about that. We'll chat about it a little bit more in fast markets. You got some upgrades, downgrades there for us, Tom?
yes, just for the viewers, sorry, I should have said this a couple of minutes ago, but BP cut to hold at Jefferies, price target 390. Legal and General cut to hold at HSBC 255, and Next reinstated as neutral at Santander.
Okay.
So 3 for the top.
Right.
FTSE 100.
Get your bell in your hand, sir.
Here we go.
Here we go. Tom Roberts opening the London Stock Exchange, sponsored in the future. Opening bell. Wow, they are off and running quick today. There's no hanging around. spot on 8 a.m. and 7 seconds, we see BP getting hit from the off, down 1.5. ITV joining it down there, as is Wetherspoons. Wetherspoons what? Because it was a cold weekend? Everybody had barbecues at home, possibly. What was the Ryanair, sorry, Phil? Right, we got Diageo is up. Ryanair up 5.3%. We've got Diageo. Can you see Diageo, do you? Up 2. Why am I not getting Diageo in? Diageo, yeah, there it is. Up 2%. Trainline is having a strong morning. EasyJet up 1.1 on the back of those numbers from Ryanair.
Yep.
And IAG up 60 bips. Anything else you've seen there, Thomas?
Glaxo is up, I think, on the back of some news this morning regarding a cancer drug approval in Japan. So that might be on the back of it. Up, it was up, called up 0.5%.
Yeah, that's exactly where it is.
Why is Fresnillo so high? That's the other one. Let's have a quick look there. What's going on there?
Should we have that? Silver, isn't it?
Yeah, I haven't seen anything dramatically fresh on that. Bear with me.
Right, quick look at commodities. Oil down 1% there. That won't be helping BP either, as well as the downgrade from Jefferies. Gold up 80 basis points, of course, because the Moody's downgrade. And copper up 40. Copper's been trading really steady around there for the past few days. So back to those stocks. See where we are. Any more on the downside? St James's Place down 1.7. The Carnival down 1.5%. And Scottish Mortgage Trust reflecting the move lower in the Nasdaq, almost point for point. What else you seen, Tom?
A quick look. So commodities are getting hit a little bit. BHP as well are down. I was just having a quick look at that. But it looks...
Yeah, JD Sports back down to 92. That's a bit of nothingness. I got out of that on Friday.
Rio's down, BHP down.
Yeah, right. See if there's anything more interesting in Europe. Wow, Volkswagen getting smashed. Down 5.6%. I haven't seen what that story is. See if the other autos are down or if it's just... No, it's just a Volkswagen story. That's... right, we'll just hold back and we'll see if that's a dividend then coming out, because that's... oh, unless the others haven't opened yet. Is that what it is? I don't know if we're still to get... No, there's Porsche small up on the day and BMW small up. So it must be something specific to Volkswagen, which I would imagine could be a dividend.
Let me see if I can see something.
Yeah.
Volkswagen.
Nothing out there. Right, on the upside in Europe, we have, Ryanair now up 3.5%. Where does that look on the chart? I haven't looked at Ryanair for a while, actually. Have you seen much trade in Ryanair?
Don't actually see a huge amount in it.
Oof.
Maybe a bit more in the institutional flow side, but...
wow, it looks really good. That's incredible. I had no idea Ryanair was performing so well. Is that all-time highs, or is that just for the last 10 years? Oh, geez, what's going on there?
Reported robust demand across Europe. Fares would rebound, recovering much of last year's decline.
I think that's new all-time highs. Yeah, it must be. New all-time highs for Ryanair. Congratulations, Mr. O'Leary. That is, one of the best bosses out there, and has got the share price to reflect it at last. After, quite a few years of languishing around those 14 to 18 euros.
Yeah.
He's absolutely smashed it. That's completely crept up on me. I had no idea it was there. I mean, EasyJet, completely disappointing compared with that. EasyJet has never recovered to
You got
COVID.
a chart of EasyJet there. Yeah.
Look at
So
that.
it's almost an opposite reversal, isn't it?
Yeah. It's been dismal since COVID. Never recovered.
Hasn't really broken through at all.
No. Interesting. Amazing. Such similar businesses, but that is just management, isn't it?
Yeah. How it's run. Also how it's communicated to the shareholders and to the public in general.
Yeah.
What your PR and IR's like, and obviously Ryanair are reasonably well polished at quite a lot of that. FTSE down 0.3 after 5 minutes, still trading above 86.50. US tech just on the way down a little bit more, but Wall Street's recovered a little bit from half an hour ago. So we'll see.
So Wall Street is outperforming, but the tech names in particular getting hit. I guess they're the well-held ones. They've bounced the most. They certainly don't have any debt issues.
With all the news out of the US over the weekend with the debt, etc., how are we in the commodities space? People probably would turn their eye towards gold. Actually, yeah, gold positive this morning, up 26 points or 0.8%. Silver positive by 0.6. Oil a little bit down this morning as well. US crude down below 61.50 now. So down a 1%.
Right, so we've seen the early moves. I'm just seeing Waka Waka there saying MicroStrategy is dead thanks to Standard & Poor's. Doesn't look dead. It's at €400. So I'm not sure what you're talking about there, Waka Waka, unless something has happened over the weekend. But let's see. Yeah, Boise saying you can't trade options and Tasty until the US Open. That's right. That's on the IG platform. I've got those 0 DTEs. Elliot Harris has done some amazing work there to get the spreads into only a tick wide.
It's worth pointing that out that, US options on the IG platform have much wider trading hours because they're OTC rather than exchange traded options that is on the Tasty platform. You're absolutely right. But quite a lot of clients will have a look at the OTC options on our platform just to get an indication of where they're at.
Yeah.
And as Rich said, the 0 dated options, you can trade those from this morning until 9 o'clock tonight, where the expiry will cut in.
So that's a kind of good guideline actually. If the US market is open, right, during those hours, then Tasty is incredible, right? And you get all those stocks that you get exposure to, many more stocks than on the IG platform. And you can, of course, trade the special structures and everything. But if you've got an idea on the tube train at 6 o'clock in the morning, then the IG platform, there. I've also heard a rumor there might be Bitcoin options in the future.
Who knows? Who knows? There is
Rumors.
There is rumours around. New products being launched all the time.
Chris asking, are IG going to expand the amount of options on individual shares anytime soon? Because the current is very limited. So the current isn't actually as limited as it looks on the app. It's just that there's not enough room on the app. So any stock that you want to trade options in, then you can actually do it on the phone. So phone one of your wonderful PCMs and they can oblige you there. And then, but if it's, and they're still only available during hours. So I would also have a look at Tasty as well.
So what we say to clients is, obviously you've got the options button on the platform. Click on shares, you'll see the online equity options on there. Usually the more popular ones out of the US, Tesla, Nvidia, Coinbase, etc. And then you can then phone us up and say, actually, I'd like to trade an option on this stock or that stock, and we'll go and look at it via the exchange, and then we'll make you a price and you can trade it over the phone. So do bear that in mind as well. But just to your point, Rich, as well, if you do get an idea on the tube or the train early in the morning, as you said, Elliot's done a great job with the index options, and they're very popular as well. So you don't have to wait until Tasty trades.
Do you think this lot are up to get a train in the morning? No, they're not. They're still sitting in Monkey Man's still in his bed with his cup of tea.
You can trade from your bed, though.
You can. I managed it for 2 years. Good, right, we're going to go on to fast markets in a couple of minutes' time. So join us, go on, put the kettle on, like and subscribe, and we'll see you in 2 minutes.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Right, welcome back to Fast Markets, when we look at some new ideas and some of your ideas. So, tell me, let's run a poll on this. Do you want to talk about Britain's newest listing and the UK's version of MicroStrategy? Right, it only trades at something like 30 pence a share, so it's a small one, it's a risky one, but do you want me to talk about it? That is the poll of the morning. I will keep stum. Would you like me to talk about Britain's MicroStrategy. Trades at 30 pence a share currently. That is today's poll. We've got a question there from Maturin, our friend across in España. Can you please explain the BNP Paribas share buyback program and the drop in price, Tom?
So BNP Paribas at the moment down 4.2%, trading just below 76 euros a share. They launched a share buyback program this morning. That program was entitled that it will be a program for 2025. It's got a transaction value of 1.08 billion, so just shy of 1.1 billion. The share buyback program did receive approval from the ECB, the European Central Bank, and it involved a contract with an independent investment service provider. So what that means is that it will need to have some sort of independent verification to continue. But the unique thing is the purchase period is only for 1 month. So they've announced it for 2025, but the purchase period of the share buyback is from today, May 19th, to June 20th.
Wow, punchy.
So just 1 month, they'll buy back just shy of 1.1 billion. And when they've done that, what you do with a share buyback is once they've been purchased, those shares will be cancelled from the registration and from the listing.
Right. But I can see the confusion because on the platform it says it's up 1.7%, but it looks like it's down.
It's down 4.3%.
Is it ex-dividend? I think it must be.
Where are you seeing, sorry, on the platform you're saying it's up?
It says it's up 1.7.
I've got the platform here. Maybe we're looking at two different things, but I've got it down 340, so €3.40.
Right, it's ex-dividend today by €4.80. So always be careful on the platform. You can have it either reflecting dividends net or the price on the day. So as you can see, the top left-hand corner, you see it there up 1.7. That is reflective of the dividend. So it ignores the dividend coming out. Whereas if you're down 4.8, that means that your charts don't take notice of it.
So 4.8% dividend or €4.80 dividend, just so we're clear.
Yeah, 4.79.
So €4.80 dividend, and it's down 330 points. So that means it's up 1.5, give or take.
Yeah.
So yeah, good point, Rich. How that's reflected on your charts and your indicators.
Yeah, it's always handy. So yeah, dividends can come out any time in Europe, but in the UK it's always Thursdays. So remember that one. Right, let's go on then. Do we have a result on the poll? Oh, sounds exciting. 80%. Right. This is now just as I say, buyer beware. Right, this one's a risky one, but for the chance to talk about something early. Well, I don't know if it's early, but you know what I mean. To talk about something, yeah, people ask it, is this the William Wallace coin? Or what are some of the other smart coins, not so smart coins?
Is this the web software company?
Yeah. That is exactly it. Yeah. It is called the Smarter Web Company. And we might have mentioned this actually about 2 weeks ago. Pete Ward mentioned it on the show. And I've got the chance to interview the CEO. And so I started doing I like to do a bit of preparation before I do interviews, etc., just to know what we're talking about. But as you can see from here, when Pete Ward started talking about it, I think it was about 15 pence, and it's already trading at 29. So I looked and I thought, right, what exactly are they doing? Why is it already traded up to 45 pence and then come all the way back off? Well, they're raising money through equity placings to buy Bitcoin. And so it's the early component of the MicroStrategy idea. But I started looking more into it, and he's got UTXO involved, and UTXO are the guys that come on board. They're quite high up in the Bitcoin world. Yep. So the fact they've got somebody on the board that has been involved in all these things before, then it piqued my interest. Then, for credibility, because these things are all about credibility, the guy who's the CEO is actually the ex-head of digital at Hargreaves Lansdown for a great number of years. So then you start to think, all right, so it sounds like, he's not like he's just sort of come out of university or something. He's been involved in the industry. He's managed to get the company listed, albeit on Aquis, right? It's not on London Stock Exchange, it's on Aquis Exchange. And so I think I'm going to interview the CEO. We'll broadcast that, hopefully. And it's one to watch.
Yeah, listed at 5p or 4p not that long ago. Shot up. It's got a market cap now, I think, of north of 20 million. It's got assets of Bitcoin worth, I think, about $1 million at the moment.
So he owns 20 Bitcoin at this point.
Yep.
But he's done the raising last week, which gets him another 2 million sterling. So, I assume that they're gradually buying Bitcoin as they go. But the idea, let's take a step back. What's the theory behind MicroStrategy? Why is this beneficial, right? It's beneficial because your equity is trading at a premium to the net asset value of the Bitcoin. So the net asset value is your Bitcoin. The equity trades at a multiple. So when you do equity raisings, you're taking, cash, fiat money, and you're taking multiples, in this case, about 6.5 multiples.
Yep.
So you get 6.5 times the cash, then you buy more Bitcoin. So your net asset value goes up. When your net asset value goes up, the share price potentially reflects that and goes up as a multiple. Now, of course, the multiple decreases over time. But when you're at this stage, when you're only at 28.5 pence, 29 pence, then there's an opportunity for that sort of early mover. And that's why I'm just interested
But the challenge here is that you are raising money and buying an asset that's at all-time highs that has a high volatility.
Oh, absolutely.
And if Bitcoin drops by, say, 30-40% back down to 65-70, how is that then reflected in the share price on the raises that have been done previously as well?
This is one of those elements that there's a community involvement as well,
Yep.
right? So, previous things like GameStop and things like that. It's had the power of the community. And these things detach themselves from fundamentals, because if Bitcoin drops 30%, the Bitcoin community take that as an opportunity and they come in and buy.
Correct.
Right? So this is only a one for people who are real Bitcoin believers, that this is going to 100, 120, 150 over time. And they want a way, like MicroStrategy or strategy, has amplified those returns. This is the British version.
And it's a proxy to buying Bitcoin. If you don't want to buy Bitcoin, as you
you
said.
can't buy Bitcoin, because this can go into your ISA.
Yep. So this is on Aquis. You can trade this in share dealing or ISA. And
It's already on the IG platform?
it is. I'm looking at it now. Trading at the moment, 28.5, 29?
Yeah, but obviously not on leverage.
No, it's
right?
non-leveraged only.
And it's non-leverage for a reason, right? By no means, go and leverage up on this thing. Because for it to be a success, he consistently has to get more interest and grow the story, and to be able to keep on raising at a premium to NAV. And that's the key behind it all. Other companies are managing it, and they're managing it very well. So it'll be interesting to see if the UK gets behind this. We've got a Japanese one. What's the name of the Japanese one? Cover me for a second there, old chap. And Metaplanet. That's it.
What's it called?
Metaplanet. This is the one that's up like 80% in the past week. Right, so there's Metaplanet. As you can see, these things are volatile, right? It's gone from 350 to 700 in May alone.
So that trades in Tokyo, in yen, obviously, as well. But that's available on the platform as well, overnight dealing. Interesting chart there.
Interesting chart indeed. And when I say that this is at the start of, I feel like we're catching this early. MicroStrategy, guess how many Bitcoins MicroStrategy has? Not the value of them. Guess how many Bitcoins out of a total of, 20.2 million exist at this moment. But at least 2 million have been lost in dumps in Wales and stuff like that.
250,000.
570,000 Bitcoin.
Wow.
He has just done incredible things.
He has.
Metaplanet own nearly 7,000. Semler Scientific own 3,600. The blockchain group owns 620. And this company own 19 Bitcoin. So when I say, if this, I just want to get the flag in the sand. If this ends up going up to be worth £3 or something,
You heard it here first.
You heard it
with
here
Rich
first.
McDonald.
So yeah, right, let's get on to other things then. We had a question there as well to asking to have look on the options market on puts. David Boyce asking puts on Coinbase and calls on UNH. So we're going to do that in a second. Tom Roberts just going to fill to allow me to log into my Tasty account.
Was just having a quick look at the indices half an hour in as well, just for the viewers out there. FTSE's dragged off a little bit more. I'm slightly conscious of the FTSE at the moment that was below, sorry, it was above 8650, now it's below 8650. It is being dragged down. The US tech, those US names that Richard spoke about earlier, are starting to drag things down a little bit, 1.3% now down on the US tech. So it is looking a little bit more red than when we first opened half an hour ago as well, Rich.
Yeah. Right, now, Boise, tell me, calls on UNH, what do you want to look at? Let's go out 32 days to June, right? Only 32 days to the longest day of the year. That's scary, isn't it? And we've, cool, we're not getting many prices in there, actually. That's got the Monday feels about it. Okay, if United Health gets an all clear and it starts to move higher, it can be quite significant, can't it? Not saying it will. I mean, there's serious risks to the business, to the margins.
Yep.
All the news flow has been pretty woeful. But if we go up to something like a 320, right? So a 10% bounce at 320. We're paying $14. Right up to 370, you're getting back $5. So $10 for $50 of upside. And if you really wanted to get a bit more risky, then maybe you do double of the 370s. So you're only paying $4.
There's so much bad news over UNH though at the moment, and potential fraud as well. With the securities fraud that was announced on Friday night as well. You've got to be a brave person, I think, to trade this stock at the moment.
And I think that's why Boise's right in the options rather than the underlying stock.
but just be mindful in the options of just managing your risk accordingly on that. But yeah, one to keep an eye on. Close to 90 underlying on Friday, so we'll wait and see.
And so you're paying 900 there to make 4,000 on the max profit. Right, we then wanted to have a look at Coinbase. So looking at puts on Coinbase. Should we go? We'll go out to July for these ones. And where do we think that Coinbase? Let's have a quick look at the chart. Had those great numbers, and we wonder, selling puts. I do think I would be in that camp as well. We've moved up aggressively from the 210 level. So do we want to have a look at if we sold the 210s, what would we get there? $5. Well, probably closer because it's a wide spread there. The $200, there we go, $4.30. So you receive 2% for selling the July 200 puts.
On our platform, on the IG platform, this is obviously Rich got the Tasty platform app. On the IG platform, you've got the Junes there as well. 210s you'd be selling at 270, and the 200s you'd be selling at 175 at the moment, with implied vol of about 70 points.
Yeah. Right, I hear Matt Arbour in the gallery. And he's saying, get Tom Roberts off the screen.
Yeah, absolutely right. Doesn't know what he's talking about. Get Mr. Arbour, the sage of IG, as he is known.
How long have you two worked together for?
On and off 20 odd years. So yeah.
20 years.
Probably longer, actually.
Any funny stories while he's there?
Plenty of stories, but he is a senior man, so my lips are sealed.
Good stuff. Right. Thank you all. Any more questions, drop me an email, richard.mcdonald@ig.com. And if you haven't subscribed, then subscribe. And final thing, I knew I had one more thing to cover. One more thing, as Matt Arbour rolls his eyes.
The show.
Exactly. Tom Roberts gave me a little nod to this. There it is, back for more. Yes, Tom Sosnoff and Tony Battista are in London on the 20th of June. The link is in the chat. The tickets are free. The bar's free as well, because Muggins here has to pay for them. And I'll tell you what, if my put ratio comes off today, so we're on for an 11-to-1 payoff in the put ratio today. If I max out on that and we close, if I make 5 times in it, I'll order some pizzas as well. There you go. Right, Matt Arbour coming in after the break with Angeline. We'll see you then.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
There are certain things in our daily lives that everyone has a view on, like your favourite clothing brands, supermarkets, or even which airlines to fly with. Maybe you're loyal to EasyJet and you think British Airways seats are too expensive. Or you'll never shop at Tesco's again because Marks & Spencer's food offering has won you over. Now, what if you could use these views to try and spot opportunities in the markets? Let's talk about pair trading. It's a way to trade that focuses on the share price relationship between two similar stocks rather than taking a view on the market as a whole. Here's how it works. Take Nike and Adidas, for example. Now, some people think that Nike has gone out of fashion recently, but maybe you believe in a brand recovery over the medium term. On the other hand, Adidas Samba and Spezial shoes have been incredibly popular recently. But have sales peaked with this trend? As a trader, you could Go long on Nike, expecting its share price to rebound over the coming months. Also, alongside that, you could go short on Adidas, expecting it to cool off after its big run in the last 12 months. It all depends on how you would like to express your own personal view on two companies. But keep in mind how quickly trends can shift. Remember when Under Armour rose to popularity fast, along with its share price. But then they spent most of their profits on celebrity partnerships and their share price performance flopped. Now, this doesn't just apply to clothing brands. Think of Tesco's and Sainsbury's in the supermarket space. Two companies that often move together. Now, if one outperforms the other unexpectedly, their trading could let you capitalize on what could be a short-term difference. Because the beauty of pair trading is that it's market neutral. If the whole market drops, as long as the gap between your chosen pair narrows, you could still see an opportunity. But don't forget, always research why prices are diverging so you're not caught out by unexpected trends or their financial results. Do you want to give pair trading a try? Start simple. Test it out on a demo account first. It's a great way to learn the strategy without taking on real risk. And on IG's platform, you can explore similar trades easily with access to the tools that you need and further education on the IG Academy.
Hey, welcome back to the show with myself, Matt Arbour, and live from the trade desk.
Morning,
How are you?
I'm good, Ange. How are you?
Yeah, good weekend.
Yeah. Nice sunny weekend in London again.
A bit like the markets last week.
Sunny market.
Yeah, sunny markets. Feels like it's very much risk on again.
Very much so. Very much so. I think it's kind of taken a sustained rally to get people's confidence back up. It looks like much more enthusiasm for buying Mag 7 into the rally than there was perhaps into the dips.
Yeah.
Which is unusual.
It is unusual, especially after the last 3 weeks that we've had. People have very short memories.
Well, it is easy. It's easy to forget. You looking at charts, and it's nothing happened. And what we're only 60 days away from another Liberation Day.
Another
countdown. Whatever, but the diminishing risks of tariffs, perhaps.
Yeah. By then we might get another 90-day. Deadline. So I mean, it's one that continually changes. But just putting up the Tech 100, because as you mentioned, we were talking about this earlier. Tech stocks, the mega tech stocks, the Metas, the Microsofts, and all that, they have really had a good week.
Yeah, fantastic week.
And it's almost like all's forgiven. The enthusiasm for U.S. assets is back. Just showing this up for you, a bit of technicals here. Looking at the daily chart here, where you're seeing the 20 period SMA crossing above the 200 SMA as well. This in some conditions. And of course, when we look at this as well, you don't use it in isolation in terms of technicals. But, it could be seen as a bullish, sign for the shorter period.
Well, yeah, I think if we weren't coming from the back of what we've just seen, which can be easy forgotten, it was like perhaps just a random bit of noise, what we saw mid-April. It does look like we're back into a very, a good bull trend again. I suppose the interesting thing is how some of the stories that were driving the volatility seem to be forgotten. Musk's relationship to Trump, on, off, it's still on. He hasn't been gotten rid of, which was bad for Tesla's share price, then really good for Tesla's share price, causing all kinds of things on Tesla's share price. But that's been forgotten. Tesla's had a great run back up. I suppose the market got excited last week with the talk of Gulf investment, UAE,
Qatar, airplane.
Well, airplane, AI. There's this sort of whatever it was, 500 billion into AI again.
Yeah.
But we had that before the sell-off with the 500 billion nebulous AI project and data centers in the US before. So how much of this is just noise? How much of it is real?
Yeah.
The market certainly likes the stories.
They do. They like the fact that Jensen was with him as well. Jensen Huang. Taking a look at Tesla, because I know Monkey Man and many others on the chat like Tesla. And look at this is daily chart here. Look at that bounce back there. It's back up to levels not seen.
Was it JD Vance, or was it one of Trump's entourage said, "You'll never buy Tesla so cheap," didn't he?
Yes.
In the midst of this.
Yeah. It's amazing, isn't it? The time that we're living in, where this is literally the top
Vice President.
Yeah.
It's not Kathy Wood coming out with delusional stuff.
It is the U.S. President,
US
and his mates.
Right.
The whole credit rating downgrade as well. Producer Phil sending questions out. Can you hear me talk back in? I now can hear you. Yes, thank you very much. I've been listening to Matt Arbour because he overpowers you, Producer Phil. I can hear you now. It's a real, I thought it was interesting that rating downgrade. Moody's downgrading, for those of you that didn't catch this, Moody's downgrading, the US credit rating.
Well, coming into line with everyone else.
Yes, exactly. Yeah. I mean, to me, it felt like behind the curve.
It's not a new story. It's kind of surprising we've seen this softening overnight.
Yeah. And yet, major indices reacted.
Yeah.
Most bizarre there.
It's a strange one, but I suppose it was the only piece of news that was there. There was something to trade on, and a bit of profit taking, perhaps anything to take some profits after what was a very strong week in US markets.
Yeah. Does this all mean that with the strong markets, Matt, that perhaps the DAX, and I'm going to pull that up right now, the DAX and its wonderful winning streak, is now in danger of being derailed?
We've all been scratching our heads, haven't we, as to why Germany is the one that keeps on going to fresh highs. I know there's the defence spending part of it, yeah, and how much of that rise has been powered by Rheinmetall, and the long-awaited resurrection of German defence spending. But even so, as it's Germany. Germany's still
powering ahead,
lots of structural problems in Germany. It's not like we have a stable government really in Germany. This is a country beset with issues, but I suppose the sentiment remains that as long as the ECB are there, pumping funding into Europe, spending for growth,
yeah.
that Germany is the biggest beneficiary.
It's still above, healthily, decently above that 23,700 level. And, it is a bit softer today, but looking at where I've highlighted there, it is still moving, relatively well above that figure. Any concern on the volatility front that we might see a reversal of this at all this week?
Well, no. Vol is a touch lower again as it was last week. We've been softening. Yeah, we've been softening through. Let's look at end of week on the DAX. So down to the 23rd maybe, or the 21st.
I've got the 21st up.
Yeah, look at that. You see vol on to the 21st. That's Wednesday's vol, less than 20%. We've not really seen that over the past month. So the market. Is the market getting complacent? I suppose is always the question here. But it's often the case as you see a steady rally and vol comes off. It's kind of the natural reaction. But there doesn't seem to be a great deal of concern here that the party's ending or pricing in a party ending.
Pushing it out to the 23rd, still around the same level.
Yeah, so it's like a slightly higher number on the end of the week. I'm trying to think what the US number is probably influencing that the further date is higher than the near date suggests there's an event between the near date and the far date. Usually you'll see over the period of time the vol decays slightly because the option pricing it's a time component offsetting that volatility component. So if you see the far date volatility higher than the near date volatility, would suggest there's an event being priced in between the two dates.
There is a concern out there that this market, recent market exuberance, shall we call it, is kind of hiding this rising concern about brewing stagflation. right, over in the US. Consumers no longer can ignore this. Every time I get a call with someone stateside, there are now rising concerns that, we are starting to see this start to boost inflation pressures.
Yep.
We've seen Trump saying, eat the tariffs to Walmart and the like, saying you just got to suck it up.
Well, this is of course what Jerome knows is the case, and that's why he's sitting there and doing the cautious thing. Keeping rates high, waiting to see what the effect is onto inflation across the economy, and to keep the weapons in his arsenal.
Keep his powder dry.
Exactly.
Until the time comes. So are you on this camp that actually, we are going to see this creep back in and the stagflation concerns really start to kick in, and then might be in a space not in the not too distant future where, JP is going to have to, be stuck in that horrible position where might have to, raise rates, even talk about raising rates, because inflation has become rampant.
Well, yeah, I suppose that the wider story here is effect of Trump's mooted tax cuts, what comes in there, the effect of taking tax off tips, etc. What this is doing for spending pressures. Are people spending that money? Are people saving that money? And the reaction of the US consumer, which has been, it's consistently the belief that, as opposed to the UK, Europe, Japan, the US consumer likes to spend the money, or they put the money into the stock market. There's no sitting on cash really in the US.
No. Put your money to work. Right, that sounds like a poll, people. Let's, producer Phil, let's have a poll to find out whether our viewers think that, there's a high risk of stagflation in the US or not. At this point in time, we've got UBS, Jefferies, analysts over there, downplaying the long-term impact of, these tariffs, and the Moody's downgrade, which I think was a bit behind the curve. But yeah, let's have a listen to our viewers to find out what they think as well. In the meantime, just taking a look at the dollar, because the dollar's showing some interesting technicals there. Punching up the US dollar basket for you here.
Oft talked about, little traded.
This one is often, whenever I speak to anyone on the desk, it's like, one that retraces really well. The dollar basket is one that the Dixie.dxy. Yeah. That if you want to trade the retracement, this is one. But this is a look at the hourly chart here for you. I changed it to 200, the 200 hour rather, moving average here, because this is an hourly chart, trader friends. And as you can see here on this red line here, if you're colorblind, it's the last line where my cursor is there. It is very well supported. The dollar basket is very well, the index, rather, the chart price action is very well supported by the 200-hour moving average. And we're now suddenly seeing this break below under this. As you can see, I'm going to zoom in to the right-hand side. And this would suggest moving to areas last seen where we last crossed or touched this. So around that, 100 mark there. So interesting one to watch. I'm certainly waiting to see what happens to this. At the moment, volumes have not tracked higher.
What are we looking like for US numbers this week? Have we got anything?
US numbers, pretty much quiet. But we have a smattering. Today, we've got Fed speakers like Bostic. We've also got Bank of New York President John Williams, Laurie Logan, and Neil Kashkari also speak. And let's have a look further out. Quite quiet on the earnings side.
It's a quiet earnings week. It's a quiet data week.
Yeah. So let's have a look. We also have the Hammock, lots of Fed speakers this week. From the UK, we've got core inflation, which might be interesting on May 21st. But also later on in the week, it's the global manufacturing flash PMIs, global services.
Very quiet week in the US for data, and yeah, no real headline companies reporting either. So
Yeah, all the smaller names,
Yeah.
all before Nvidia.
yeah.
The only one that I would pick out, just because it gives us a better view of how the consumer is feeling. We also have existing home sales on May 22nd out of the US, and from the UK, it's all about the consumer on May 23rd because we've got the consumer confidence figures and retail sales as well.
Yeah, I think we've got a few more UK retailers reporting this week as well, so a bit more interest in the UK than the US. But an interesting week on US markets, I suppose, with nothing really for people to get the teeth into. Perhaps that gives a chance for Trump comments to come through, or just for people to actually reassess the events of the past week, the strong moves we've seen, and be interesting to see if the rallies continue without any substance there to back things up.
Maybe some respite is good for the markets to shake out.
Well, yeah.
Speaking of the UK, do you have any expectations as to what might come out of the UK EU talks taking place this week? I'm going to whack up the pound cable as you're talking about
it's
that.
kind of a strange one, isn't it? When last week there was celebration over getting a deal with the US, and the US don't really have a lot of time for the EU. So it's almost sticking a finger back up at the US that you're looking to move close to the EU again. I kind of feel this might provoke a certain president.
And kind of like I thought about that and reading the headlines, thinking, what did this country vote for again? Not too long ago.
Wow.
So the key points, just a gentle reminder for those of you that are trading this event is, they're looking at sector by sector deals to try and reduce trade barriers. They're also looking at animal and plant product regulation.
Which is an interesting one, because the UK post-Brexit has long said that our regulations are tighter. Our farmers, we've got the highest standards. We have everything, and this, cross-border trade is the issue to try and reduce the friction when moving your animals around Europe, I think is the line. But the farmers once again, perhaps are not going to be happy people.
And the UK Parliament has actually said to them time and time again, we won't throw you in the bus, don't worry about it. But we are going to talk with them. We are going to talk to the EU.
And the food part is a consistent sticking point for the US with trade deals with the US.
I was waiting for you to say chlorinated chicken.
Chlorinated chicken. It wasn't far away. Which it kind of always blows my mind. I've not tried chlorinated chicken, but when you go to the US, you're not thinking, God, this chicken tastes terrible, or this the beef in the US. This is of a lower standard. Generally, people go to the US and say, "Wow, I had a great steak."
Actually, I do.
Okay.
I do. The best beef I've ever had, and this is for someone who's lived in 4 countries, is still a British Shorthorn. Her name was Belle. It was super fresh. But
You don't want your beef super fresh.
I
It needs to be hung.
It is hung. But what I mean is, like, I could see where she grazed and stuff like that.
Okay.
But I do find that there is a difference in taste.
Okay.
But we will talk about this in a bit, because I just want to show you. Cable got Andrew McKilvey also asking me whether or not there is likely to be a deal in defence.
Well, this is the great hope. I didn't look at. There didn't seem to be any appreciable movers, but UK defence stocks. The idea that we signed this deal with the EU and that filter through on the defence spending comes through to UK companies. The BAE Systems, Rolls Royces, they reacted this morning. Anne's going to pull up her wonderful defence watch list.
I love it. Where is it? I've got such a... Here we are.
Defence, not defensives.
Not defensives. There you go, yeah.
Wow.
The gallery account calling out the wrong watch list. They're all like, they're down there. No, this is the one I'm looking for. EU and other defence.
No UK stocks are there. It's BAE Systems, which is down today. So,
It is
so that is what the market is thinking. Kinetic down as well. So
Yeah. I've put up the ones that I'm interested in. So BAE Systems, as I've told RSACs and many of you on the list, just because it's so big, right? It's got its finger in every pie. And I've got names that are in the drones and anti-drone space, because the warfare that we are looking at today and the future will be fought way before it gets to past your borders. So that means drones and anti-drone, detection systems, right? And the software, your Palantirs, right? Your Red Hat, those sort of systems. And Tripper Kilby and Matt, feel free to dive in with your comments as well. I'm on the camp that for the UK and EU in general, there's already a very high standard of collaboration on defense. Yep. Maybe they might look at, cyber, or they might look at perhaps sharing of information, but I'm not sure we're going to see any deals, big deals in the defense space. That's my humble opinion, because we're, already at a high level of those sort of, that relationship. But if they say anything whatsoever about, having negotiations and talks in the software space, cyber attacks, sharing of data, sharing of AI systems, then I think I'll get excited. But at the moment, it's a really wait and see. I don't think anything's going to happen in this space.
I'm not sure anyone wants to share any of European AI systems. What's that cutting edge stuff going on?
From the aspect that it might be so behind the curve,
Yes,
that might be worrying. Poll is out, trader friends. Are we at risk of stagflation in the US? 39% saying yes, I'm worried.
It's pretty split, this, isn't it? It's not often you get a poll with no real winner.
Yeah. Only time will tell. Producer feels only time will tell. 35%, It's pretty even at that. Not at all, 25%. Right, we are being told that not much time left to go. So very last line to our trader friends for this week. I'm buying you time because producer Phil's about to come in with the crook. Come on, Matt.
Coming with a crook. This week I think that hopefully, if we see the market suggesting things were a bit quieter, a good time to pause and have a look, and again it's picking out those single stocks. It was a big wave last week. Everything went up. I think even the stocks which has had poor news stories during the week on Friday saw decent bounces. Coinbase's decent bounce. United Health having a strong bounce after
Coinbase even bounced after
after the hacking.
I know, it's almost like 24 hours later everyone forgot about the hacking.
Yeah, I suppose the inclusion in the S&P, the general crypto rally.
I was worried. I could not get into my account on Friday. Oh my God, what's happened? Right, we're gonna go. But always a pleasure having you on. We'll see you again Tuesday. Any questions for Matt, please bung them here. Like and subscribe button, slam that, because we want to be well on our way to a new fancy bell that we can get Matt hitting or ringing when he comes in. Right. We got Martin Harris coming up next, so and many other guests, so stay right where you are.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hey, welcome to All Sessions with me here at Trade Live with IG. We are less than 20 seconds to the opening bell. What an exciting day this is, because we have had quite a week across the US last week, because it seems like the party is back on, wrist back on. Let's have a look at All Sessions for you. We are out of the gates here, taking a look at my list here for you. We have Novavax up 13.5% there. Some of the Virgin Galactic names, space names, up 7% there as well. And we've got Novo Nordisk up 1.07%. Pfizer, some of the drug makers also having a better day. Let's have a look. What is it, Phil? You said in my ear? Come again? Okay, the Mag 7 are down. Not a surprise, really, given they had such a stellar week in the last week. Let's have a look at some of the losers there. We've got Beyond Meat down 3.6%. This company, which makes faux meat patties and the like, keeps on giving on the downside there. Plug Power also down 2.6%. Lyft, some of the ride-hailing companies' names there. Lyft down 2% there, and we are also seeing Boeing flying lower, 1.4% there. Boo, says the gallery. Riot Blockchain also down 1% there. Hims and Hers, Monkey Man, if you are still if you still got a position on that, it is down more than 5% all sessions there, but it has had quite a lot of volatility, and recently, look at those big, this is the weekly chart here, it has had, showing you the daily, it has had quite a climb, so we might be seeing a bit of the froth coming out of the market. Be aware though that this might be a retracement as it tries to get back to highs last seen, if I look at my chart there, when we saw these highs back there earlier this year, I believe. Right, let's have a quick look across the European markets now, whilst we're waiting on a quick last-minute substitution. It's like a football match here. Aaron Bright will be coming in instead of Martin Harris, so we are waiting on him. Let's have a look at Tesla, because Damo is saying Tesla dumping. It is indeed Damo. Good morning to you, Damo. Where are you coming from? Are you here in the UK, or are you somewhere in the antipodes? Or we've got people as far as Germany and the US tuning in as well. Tesla has had quite a good run recently as well, so no surprise that it's down 3.6% there. Just a quick overview as well, as I mentioned, let's have a look across the UK and also Germany. Starting with Germany first, we have some of the big movers there, Commerzbank and Deutsche Bank up on the winners list there amongst the top three. We also have BASF up 0.2%, and Heidelberg Materials as well. Those of you trading the auto space, Benzi or Mercedes-Benz up 0.5% this morning. On the downside, we have Volkswagen down 3.7%. SAP also down 1.3%. And looking across the universe in the car space, Porsche also down 0.5%. Right, we're going to quickly go to the short break as we get Aaron Bright on, but stay here because we are going to get through all the expectations, how to trade the housing starts and the US data right after this.
Bring me the next shiny new thing. Bring me the next shiny new thing.
So today we're on set filming our latest ad campaign for IG Invest. IG Invest is the latest innovation from IG. It's aimed at those who are interested in investing or maybe have a bit of knowledge but want to become more experienced. And what we've done is created a really beautiful, easy to use app, and now we've got to publicise it, and that's what we're doing today and trying to capture. So we worked on this ad campaign with Otherway, who are our creative agency. And what we really wanted to do is think about breaking down the barriers to investing. And so we wanted to think of an idea that was playful, fun, but also inspired empowerment.
So essentially, look, a lot of financial advertising can be quite dry, a little bit kind of wallpapery. And I think the idea was just to create something that was really eye-catching and kind of use that distinctive IG red, but put it in this really interesting metaphorical space where investors felt really kind of calm and kind of very effortless in what they were doing.
So my work is colorful, it's poppy, it's quite surreal, and I think this is one of the projects that is a perfect match. It's really nice to have a company that's very brave in their approach, and I think as a creative, as a potential target audience of the whole thing, I think it's going to work very well.
There were too many people to name who've worked on this project. You know, at IG, it's really important that we move at pace whilst delivering really high quality work. So we've had to have the best brains in the business on this one, and we really hope that you like the result.
It's been a real pleasure working with IG. I think ultimately as a brand, they're really keen to push things and kind of take the financial kind of advertising space somewhere slightly more interesting. So it's been a real joy for us to work with them and help them kind of get there on their journey.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Welcome back. We got him right here. Aaron, thank you so much for coming back. I was surprised to see you. Last minute substitutions, like a football match here. Because I thought Martin Harris was coming in and giving you a break after your long exam.
Yes, but you know, I'm always happy to chat markets with yourself and with our guests in the chat. So always happy to come in and talk.
Fantastic. And producer Phil is also back from Magaluf. From Menorca, rather. We called him last Friday, and yeah, Rich and I very pleased to see you back in the hot seat, Phil, because yes,
deserved break for him.
Well-deserved break. Yeah, Boston Frank chiming in. Tesla is extremely overpriced. It has a forward P of 169. Yeah, woof.
Yeah, that's certainly overpriced in my eyes when you see a P in the triple digits.
Yes,
for sure.
When you have your smart portfolio hat on, what kind of digit? I'm always curious because everyone has a different number.
Yeah.
But what is your number for forward PE?
Well, I mean, when you're talking about numbers in the context of sort of multiples, you have to look at it in the context of averages, because if something is trading at a forward PE of let's say Tesla, for example, 169, but the average is say 200, then you'd say it's, you know, even though it looks expensive relative to the long-term average, it's cheap. Obviously, that's an example. You know, this Tesla is obviously overpriced based on these statistics, but you know, we'd look at something like the US and we'd say, okay, maybe the long-term average S&P 500 between 18 and 20. When it gets to 25, it looks a little bit pricey, that kind of thing. But obviously, in the context of something like the UK, we'd look at slightly different figures, probably closer to that 10, 12. You know, when we're looking at the FTSE 100, maybe 15.
So you compare it against its peers.
Of course. Yeah, you have to compare it against its historic averages as well.
Yeah, just whacking up the fundamentals too for Boston, Frankfurt, Tesla on our platform here, because you can do that very handily. This is what I love about the IG platform. It's really easy to navigate, not messy, not hard to find. Top bar there. EPS as well. I mean, we've got a figure there. Do you look for a specific, earnings per share? Is that sector specific?
Well, we're sort of looking, once again, because we're not stock pickers per se for the smart portfolios. Obviously, we have an idea of the large positions we have in various stocks within the portfolios, but we're looking at, trends across geographies and indices level rather than one company. Obviously, the bigger the company in market cap weighted indices, which the majority of our portfolios are invested in, we are looking at the bigger names. So we're looking at the Nvidias, the Googles, the Apples, the Amazons,
Metas.
Yeah, absolutely. And in the FTSE, we're looking at the Shell, AstraZeneca, we're looking at those earnings. And if on average the index is the earnings per share is growing at a nice rate, then obviously that's obviously something that we're going to be pleased about in terms of the context for sort of equity growth over the sort of short to medium and even long term.
What makes you think, I'll change, change my mind if? What is the biggest, top thing that would make you change your mind about an allocation?
Well, I think when you're looking at stock markets, we know how volatile they can be. And I think this year has been a fantastic learning curve for all investors, because the rhetoric this year has been so interchanging, I'd say. We've now got sort of positive rhetoric coming out of US, China.
In such a short time.
There's that sort of soft piece, no agreement, but kind of an agreement.
Yeah. We're going to agree that we're going to agree something.
We're going to agree that we don't want to pay more tariffs. So we're going to cut the tariffs, even though there's nothing formally agreed.
Yes.
So, yeah, I mean, and we're obviously looking at we're going to be looking at the macro noise, we're going to be looking at the sentiment. And I think guidance is always quite interesting to look at, because obviously CEOs of businesses are looking at the macro as well. They're looking at their bottom line, but are they going to take huge expansion projects if they see, the economy souring? Let's say I was the CEO of an airline and I knew that there was, concerns over rates, high interest rates and high credit card debts rising and defaults rising. Would I want to sort of expand, buy new aircraft, plan new routes? Potentially not. And so that's why the guidance is quite important as well from large CEOs of these big listed companies, I would say.
Yeah, Boston Frank chiming in and saying, I think US stocks have topped out short term. I mean, that's why we've been seeing, this continued DAX exuberance and also to some extent FTSE as well.
It's a good point, because I think markets are just incredibly emotional. We're really seeing the psychological moves in markets, and I think next time Izar's on here, I'm sure he'll delve into that. But we're seeing sort of moves which are really, I think, cognizant of the fact that, and aware of the fact that things are changing really quickly. Even though we've got some poor macro data, things are changing fast, and the expectations are changing based on what's going on with the trade deal, because that influences the whole sort of economy, inflation levels, growth levels. So people are really fixated on macro, which has been really quite interesting.
Yeah, so let's talk about how we trade this, because we aim for this program to always be useful to our trader friends out there. And those of you investing in your longer term, portfolios, you self-select your pension funds, like I do. All this feeds into what I'm about to show you. I mean, take a look at this. This is a chart from LSEG data stream, G7 currencies that have strengthened against the US dollar since Trump took office.
Yeah, really interesting data there.
So just read out the percentages
so
for us.
We've got a sterling appreciation of 7%, euro 7.4, yen 5.5, and the Canadian dollar 2.7. And obviously we've got a really big piece of data coming out over the weekend that Moody's, I think, is downgrading US institutional or sovereign credit rating. And I'd expect this to potentially weigh on the US dollar and also particularly long-term treasury yields. Because at the end of the day, if your credit rating goes down, investors are going to demand more of a yield to invest in your debt, especially if it's longer term. So we've seen moves in the 30-year yield, and I wouldn't be surprised if we see the same in the currency, although if we do get big sell-offs, which I don't think we will, because the downgrade's not that significant, really.
No, and I felt they were behind the curve, actually.
Yes.
You know,
Yeah.
they were just joining the rest of the bunch.
I mean, Rich has been wanting to downgrade the US for years.
Since we started the show.
Exactly. So unless we see really, really massive shifts in yield and currency, I wouldn't expect the Fed to get involved. But, you know, they're always there watching like a hawk.
Yeah.
But it would be really interesting to see how the US Open reacts today. Obviously, we've seen some moves in European and UK stocks today, but I mean, nothing too crazy. One down 1%, down 0.5%. We're not talking, you know, 3, 4, 5% down on the basis of that news.
Yeah, and pretty much seeing, you know, signs of, if I whack up the US dollar basket, just showing everyone there, you know, technicals are suggesting that perhaps we are going to see, you know, a bit more softening of the US dollar. I mean, we're seeing it softer now than when I last spoke to Matt Arbour about this. I was showing everyone the hourly chart here. This is the hourly chart, and you're seeing that red line at the bottom there. Very clear support there on the 200-hour moving average, and a break below this. What does that mean? And well, we have broken below this, is heading lower, and you know, we are getting close to the levels last seen 14th of May. You see that shadow there towards the bottom where my cursor is. So it is tracking in that direction. You know, this truce that we're talking about, we're going to agree, but we're not going to agree on any details, but we're going to agree. And hey, suddenly Christmas is saved, right?
Yeah. We can get our Temu imports now.
Temu and Shein. Let's have a closer look at this. I've got another chart that I'm punching up here. What was interesting was I was expecting, because the last thing Trump and co want is to have expensive Thanksgiving and Halloween tat. I mean, they love the Halloween tat.
Yeah.
And their Christmas cheap Christmas decorations, everything. Last thing he wants is everyone to be upset about that.
Absolutely. And if you look at his base, it was a lot of it was from sort of that Rust Belt, Middle America, who want to see a growing America and want to have, you know, American cheap goods, I guess.
Yeah. Make the dollar, you know, great again. The easiest way is to get oil prices cheap and also get goods cheaper, right?
Definitely.
But yeah, this is interesting. But the one thing I was waiting on was this China rare earths, agreement. But the interesting thing is with this truce, this pause, the rare earths, which is really, really key to making everything from smartphones, right, to EVs, that's all flowing again.
Yep.
So for the meantime, it's understandable that, you know, markets are taking this as a good thing.
Yeah. And I think for business owners and even large scale businesses, it will be good because, you know, you don't have to constantly look for new opportunities to save your bottom line before. And I remember having this conversation with my dad recently, and he was obviously in the fashion business, so he knows.
Brave man.
He knows how tariffs can really affect the bottom line of these businesses, and how difficult it can be to find basically profitable supply chains when basically costs come up massively, and these are essentially additional taxes.
And what we're seeing, trader friends, on a chart here as well, is that you know, this truce shows you, you know, how reliant. I mean, to me, this just shows you how reliant the two are. And China might hark about, you know, how they want to make their domestic market less reliant on the US and their economy less reliant on the US. The crux of the matter is it cannot happen overnight, right?
Yeah.
And vice versa with the US as well.
Totally, and some of these supply chains will have long-term contracts locked in for goods for, you know, many months away.
Yeah, so I am looking towards, you know, companies. You can bring my chart off now, Phil, producer Phil. Is that I am looking at companies like Walmart, for example. Some of the big ones that have been in the news recently. See, Walmart, all sessions there. You can trade this right now. In fact, 18 minutes in, and we are down 1.6% there. Walmart, of course, is the bellwether of the consumer industry. It has already said it's going to start raising prices because of tariffs. Home Depot and Target and Lowe's, TJX, I don't know whether you ever go to TJX or companies under that company, but it's really, really key that we saw data showing that retail sales
Yes.
have started slowing.
I'm always surprised when I go to the US and go to Walmart about the sheer size of the shops. They are absolutely enormous. And we've got some big supermarkets here, but the actual physical size of some of those Walmart stores is quite unbelievable.
They've all front-loaded, most of them anyway, in terms of what they need to sell, right? Now that there's a pause, it might be, they might be breathing a sigh of relief. But the fact of the matter is these tariffs haven't yet all gone away. And I'm thinking if you're trading the space, bear in mind that we are coming up now to the time in which they have to start buying and loading up for the Thanksgiving, the Halloween, the Christmas. We are going to start seeing these companies, these names, the Home Depots, the Walmarts, and Targets continually have to just update investors to say, you know what, those Barbies, you're now not in a time where you're possibly buying
20% more.
Yeah. You're not going to, have that stocking, that filler. Perhaps, when Trump's already said less Barbies, less pencils, something it implied something like that. 90% of S&P 500 companies have reported, and they have had earnings set to climb some 14% year on year. I, in my humble opinion, not expecting to see this in the next reporting season.
I agree with you, and we've had some strong earnings growth for really since 2022, 2023. So, the momentum will likely come off at some point, and also we've got some more macro pressures, which are, baked into it now, and likely to impact these companies' bottom lines at the end of the day. And if you've got a weaker consumer, it's a double whammy, right?
Whacking up a chart for you here, whilst it's loading, do you agree that the US economy is likely to have more downgrades than upgrades in the coming months?
I think there's certainly a chance of that, depending on, really the data we're getting on unemployment, see how that changes. It's going to be interesting to see what happens with this tariff picture, because we're not out of the woods yet. And, if we get a concern where we might get a concern is if tariffs come back into the fray and they are at elevated levels, we could get essentially a weaker consumer paying more. We could get higher inflation and, potential stagflationary concerns. That's sort of the worst case scenario. So just because markets have rallied, just because things seem a bit nicer than they did maybe 4 weeks ago, we're not out of the woods yet entirely. And it's certainly, not the most bullish environment, I'd say, not the most, optimistic of places to be. There's still a lot of things which need solving, and we need more clarity on certain things.
Yeah. So just looking at this chart here, you're seeing the stocks that show you the change in their share price since the start of this year versus the S&P 500. And as you can see there, Target, the underperformer there. Costco, I don't know whether you've been to a Costco before.
Yes.
Have you been to the ones here or the ones in the US?
In the ones here, there's one about 20 minutes from me.
Okay, so I've never been to the ones here. Director Cam keeps telling me that their hot dogs are really good.
Yes, they've got something like they've kept the prices of the hot dogs and the rotisserie chickens the same. And they lost leaders, apparently.
Yeah, just to get people in, right? Yeah. People like Director Cam. I've only been to the ones in the US, and it's clear to see that anyone buying and wanting to get the price down, getting costs down, they go to the Costco's to buy in bulk. The likes of Target, which sells everything in the US. I was there in the summer just looking. Everything from, they've got a space that sells like, tires, car tires to, knock down Nikes, Adidas, everything is in the mix there. So they are less on the sort of cheaper end. And as you can see there, their share price is reflecting that. Walmart sitting somewhere in the middle there because it is, a staple for the US consumer. Speaking of downsides, let's take a look at, if you can take off my chart right now, because perhaps one way of trading this, trader friends, is if you think that the retail space in the US is going to be hit, then, and looking to, for example, Netflix, which does not have that sort of tariff implication, then you'd like to then perhaps short US retail stock, like the ones that we talked about earlier, but then go longer, play like Netflix, which, you know, whether tariffs go up or down, they seem to be able to sidestep it.
Yes, absolutely.
There's a strange odor right now in the studio.
I wasn't sure what that was, but now I've realised
was that rich?
It smells like my changing rooms when I was at school.
It's rich, spraying Lynx Africa into...
There's a mist now coming up.
Right. The Brexit reset. We are not so long ago, you know, this little island, you know, voted, it was historical, right? And we were all here. Now there's a meeting between the Europeans and the Americans to try, or rather between the Europeans and the British to try and rekindle the love affair, shall we put it. Are you expecting anything big out of this, or it's just something else that, you know, it's kind of like flying under the radar, might be interesting, but actually not much is going to happen?
I think that it's nothing absolutely monumental. I mean, there's been sort of a deal in place for a while. Things have been sort of okay for a while, but you know, I think Keir Starmer is, I think, fairly unpopular in the UK. If you look at sort of polls on his sort of premiership, and I think, sort of from a more cynical perspective, he wants to score somewhat of a political win with this.
But not push it too far, that the Eurosceptics then, you know...
Definitely, yeah. I mean, he's seen a lot of negativity from the general public, I'd say.
Lots of data points out there showing that, you know, the economy is not in great shape. We've got, you know, the dominant services sector contracting, and I'm going to show you this chart here, if I may. Company activity also sinks to contraction for the first time in almost 2 years. Consumer price data, you know, the consumer still not feeling like they are in a great place, also showing that the tight labour market has kept inflation too high for the Bank of England to cut rates.
Yes. That's certainly something which is going to be really interesting to watch.
We need to go to a break, trader friends, but do stay there. Do slam the like and subscribe button. We are going to be right back to tell you more about this and also perhaps get you more technicals with Axel. Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer 2 ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing.
So today we're on set filming our latest ad campaign for IG Invest. IG Invest is the latest innovation from IG. It's aimed at those who are interested in investing or maybe have a bit of knowledge but want to become more experienced. And what we've done is created a really beautiful, easy to use app, and now we've got to publicise it, and that's what we're doing today and trying to capture. So we worked on this ad campaign with Otherway, who are our creative agency. And what we really wanted to do is think about breaking down the barriers to investing. And so we high quality work. So we've had to have the best brains in the business on this one, and we really hope that you like the result.
It's been a real pleasure working with IG. I think ultimately as a brand, they're really keen to push things and kind of take the financial kind of advertising space somewhere slightly more interesting. So it's been a real joy for us to work with them and help them kind of get there on their journey.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Hello and welcome to Trade of the Week on Monday the 19th of May 2025. And let's look at today's trade, which is to go long the British pound against the US dollar, because the US debt was downgraded by Moody's on Friday. And also because of the recent trade deal, or the announcement of a possible trade deal, probable actually, between the UK and US, perhaps aiding the UK economy to do better in the future. So from a technical perspective, if we look at the British pound against the US dollar, we can see we've been in an uptrend since the beginning of the year on this daily chart here. And at the moment, we are in the process of breaking through that resistance line which we had in place since late April. It's actually a downtrend line because we had 3 touching points, and the fact that we've broken through that downtrend line today, plus have risen above the high seen last Wednesday at 133.60, leads me to believe that we are going to head higher in the coming days and weeks. And how far could we go? We can see here we topped out back in April around the high seen in September of 2024. That was just above 134.30. And if we manage to break through here, which I believe likely, we are most likely going to be heading back up again towards this resistance area here, towards the 138.50 to 139 area on cable. Now, just for transparency's sake, I'd like to also mention last week's trade, which was to go short New York cocoa. You can see here the cocoa price was falling. We were at resistance, and I thought we were going to come off, which we did a little bit, but we didn't hit our downside target. And instead, we went back up again, and we got stopped out here with 2% hypothetical risk on that trade. And the week before, we went short the US dollar against the Japanese yen. And again here, we were unlucky. We went short around 144. came down a bit, but then we got stopped out above this high. Now we're trading back below it. But yes, these two trades didn't go right. But let's go back to today's trade of the week, which is to go long the British pound against the US dollar at around current levels at 133.60, with a stop loss below the current May low around 131.39 and an upside target around 138.50 to 139.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Welcome back to Technically Speaking, where I go through your charts and where I explain a bit more the technical picture with regards to the previous trade of the week. So let's just do that and look at the British pound against the US dollar. Now, why do I want to go long this one? Well, as I've just said, basically you can see here that since the beginning of the year, we've been in an uptrend and a pretty healthy uptrend. We've risen quite strongly. And what we've then seen basically since the highs around late April is what I perceive to be an Elliott wave ABC correction. And now what that means is just a zigzag correction where the market goes down, up and down again. And this second leg here in distance is similar to the first one. And then you can see here we had a bullish reversal to the upside on Tuesday of last week, then traded sideways. And earlier today, we broke through this downtrend line because we've had three touching points, one being here, the second being there, and the third being here. And we also rose earlier this morning above the last reaction high. What is a reaction high? Well, for those of you who follow, technically speaking, you know that it's simply a high on the daily candlestick, which is higher than the one to its left and to its right. That was made last Wednesday at 133.60, and we managed to rise above there, which basically confirms this trend line break. Now, ideally today, we would like to see a daily chart close above 133.60 to confirm on a daily chart closing basis this downtrend line break. But if it were to take place, then we should be heading back up again towards this previous high here, which we made at the end of April. Now, if I go onto a weekly chart, you can see here that one was very close to the high made back in September of last year. So quite a bit of resistance around 134.30 to 50. But once we break through there, which is likely because look, can you see here, we had this very strong uptrend. And every time we get a correction, it continues to go up. Here, 2-week correction, 4-week, 5-week correction, and here we've had another 4 to 5 week correction. And we've also got potentially this hammer formation on the weekly chart last week, all of which leads me to believe that we could be heading back up again. You can see here also, if we close on a weekly basis above last week's high, 133.60, this is also pointing towards further upside being seen. And even if you don't believe in that, the odds are in your favor anyway, because about 70% of cases, the trend is more likely to continue than not. And you can see here we had a very healthy uptrend since the beginning of the year. So for those reasons, I expect the currency pair to go further up. And you can see here we're currently in our fourth month, and perhaps we're on track for our fourth consecutive month of gains. And if we take out this resistance area going back to September of last year, we should be heading back up again towards these highs we saw back in 2021 on the British pound against the US dollar. So what is if we're wrong? Because after all, we've been wrong on the previous two trade of the weeks of the last 2 weeks. Well, we've got our 2% hypothetical stop loss in place. Now, I didn't place this below the last reaction though, because you can see here that's just part of a consolidation phase, so it's too tight, but I've placed it below the next lower one. You can see here, this is below this one, and this is below that one. That's the current May low, which was made on the 12th of May at 131.39. So if we go below here, then this is just a sideways trading phase. This is not an ABC zigzag Elliott wave correction, and that basically means that most likely we're going to continue to trade sideways or perhaps even fall further back down towards this uptrend line, which we've had in place since January of this year. And this would be the 130 area or so if we were to take out that 130, 139 low. But right now, I expect further upside to be seen for the reasons I've just mentioned. Now, I've got questions here with regards to your trades. We've got Mara Holdings. Let's have a look at that and let's analyze it together. So what can we see here basically is that we can see quite a lot of volatility, and every time it goes up, it spikes higher, comes down again, spikes higher, comes down again, spikes higher. And here it spiked higher, but it came down quite a long way. So from the high seen back in November 2024, we've come off a long way. And that low we made just recently at the beginning of April was within these consolidation areas where we have areas of previous highs and lows going back to 2023, April to May, and also going back to October of 2023. So from the last high, if we go back and look at the trend, we're drawing a trend line. We're making sure that no data is going through the trend line. So for example, had I drawn this one in, this one would be incorrect because basically, can you see here, we had these data points going through the trend line. And this is also the reason why for me a trend line break on its own doesn't mean much. I always like to go to the left of my chart to check whether we can also go through the previous reaction high. Because can you see here, we broke the trend line for a day, we closed above it, but then we just resumed the downtrend. So for me, for a trend line break to be seen, we need to take out this high here. So let's just redraw the trend line to make sure we have it correctly on here. And we can see that basically we are breaking out of this downtrend, and that one here had no data going through it here, that resistance line, until this point there. And then we broke through here, and then we broke above this high. I mean, you could have redrawn it to this high if you wanted to. It doesn't really make much difference in this case because the break is pretty obvious in both cases. I mean, let's just do that. We draw this trend line through this high now, no longer that one there, but this one here. And you can see we went through here, we closed above the trend, it closed above the last reaction high, which is this one here, went sideways and then went up. So that's bullish. Then the fact that we retested this area here and held is also bullish. So short term, I'd say we are bullish, but we need to hold above our current uptrend line or support line. Can you see we only have 2 points? It's a tentative trend line, 2 touching points, not 3. And you can see that we have a series of higher highs and higher lows. So that means that short term we seem to be going up. But as I said before, I would like us to take out this high here from the 7th of March. And that was made on the daily financial bet at 1,623.5. So we did that more or less on these days here, we're just trading sideways. So yes, you could now go along thinking that this break is actually valid. Ideally, what you want to see is a rise above these recent highs, this week's and last week's highs, in which case we could then take out that resistance area here and head back up again towards these highs here seen at the beginning of the year. Where's our stop loss? Well, if we go to the left, we have this support line here, and we also have the last reaction low. So ideally, you have to stop all the way down here, but you have to have a tighter stop. Maybe don't place it below the 6th of May low, but below the slightly lower one. Can you see that? It's ever so slightly below that one. So you don't place it below the first reaction low, but the second low one, which is this one here. So here could be a stop loss. And you can see that stop loss would also be below these lows here. So maybe just place it below the 25th of February low if you are long. That's the sort of analysis I would do on this stock, I guess. I've got another question here from Steve. Hi, Axel. Do you need to retest after a breakthrough, or aren't you too worried about that? Sometimes a retest is better because basically you've got less risk, because if you retest a break, like for example here, if you had this break here, you go up and then you retest the downtrend line, the broken one, you get a better entry signal with a tighter stop than you do on the break here. But sometimes the market, if it's a strong reversal, will just move away very quickly and you won't have the opportunity to get that retest. So Steve, it really depends on your approach. It also needs to be something that you're comfortable with, because it's no use me, for example, giving you trading strategies and setup. If you're not comfortable with them, you're not going to trade them the way that I do, and therefore the results won't be the same. So if you prefer to have a retest, make that your strategy. If you're not bothered, maybe trade half your position and write everything down in a logbook so you can compare the two then in sort of 3 months' time or something like that. But see what happens if you get a straight trend line break and you just go with it straight away, and compare that to one where you actually go in with a retest if you get that retest. So that's how I would approach it. I've got a question from Blake also. Do I think that Lloyd's has broken out from its trading range? Well, let's have a look at Lloyd's. So Lloyd's Bank in the UK, and you can see here Lloyd's Banking Group. It does look to me that we have broken out of this sideways trading range. Why? Because last week, for the first time, this high here made on Wednesday was made on a daily chart closing basis above the high we saw at the end of March and above the high seen at the beginning of March, all of which is pretty bullish. And the interesting thing now is, even though we haven't had any upside momentum, and it may still be a false breakout, sometimes this happens, you get this breakout, everybody's bullish, and then you get a reversal to the downside. But for that scenario, you have stop losses in place, and we can talk about these in a minute. But basically, if you have this break above previous highs, if you've got an uptrend, which we do clearly have here, we have a series of higher highs and higher lows since the April 7th low, I would consider this to be a valid break. Now, if we were to revert to the downside short term, where could we see support? Well, we take the previous highs, and you can see all of these highs here. This high going back to the beginning of March, the end of March, and then this high here going back to the 29th of April. All of these now should act as support. So that is the support area. You can see slightly below that we've got the uptrend line, the support line here, because we've only got 2 touching points. So all the way down to, let's say, 73.65 or so, we have pretty good support for the Lloyd's Banking share price. And if you want a wider stop loss than that, which you probably need in a big break like this, then you could take the first reaction low, which is this one here, the low from the 13th of May, last Tuesday's low at 71.81, or even better, the one to the left. So you take the low from the 2nd of May as your stop loss if it's a medium-term trade. Because if we fall through this one here, yes, we had a break to the upside, but if we fall back below this one, what we now have is no longer an uptrend, because we have a series of higher highs, but we would also have a series compared to this one here of lower lows, and that's the definition of a sideways trade. And that means that basically this resistance area didn't really get broken through. But right now it looks as if we've managed to break through it. It's not a convincing break, because as you can see here, we're just sort of treading water above this previous resistance area now because of inverse polarity, a support line and support zone. But yes, it looks as if the break is valid. Away from the numbers, another question. I'd welcome your thoughts on 2 UK charts, please. Greg's, we've got results out for Greg's later on this week, so that'll be very interesting. And B&M. Let's just look at Greg's first. It helps if I were to spell it correctly. And we can see here that Greg's was trading sideways, was trying to find a bottoming formation, did manage to break above this high here, the 12th of March high, and closed above it on Friday. That break here is very bullish, and it's a big move up. So that, to me, would be bullish. Now, obviously, very much will depend on the results, and it'll depend on earnings, but from a technical perspective, without knowing anything about earnings, well, we've got our support line here. We've got this valid break here. Ideally, what we want to do is take out all of this resistance area here. Can you see all these previous highs? But that goes up to sort of 219.6. Here, the late January high. But short term, it does look as if we've seen this bottoming formation form. So yes, we may actually go back up again, but the trend, as you can see, longer term is still pointing down. So even though we're trying to form a bottom, be careful of that, because sometimes you have these bottoming formations, as we saw basically in November of last year. It looked as if we managed to test that previous reaction high, but can you see here, we didn't manage to break above it there. And then we tried to retest it and then we failed. So that might be something similar here. But right now it does look, to be honest, a bit more constructive because we took out that high here. So it is possible that we're forming a bottom in Greg's and that we could be heading back up again. Your stop loss is ideally the 7th of April low. If you can't have it that wide, I would probably put it below the second to last reaction low, not this one, but this one here. So the 6th of May low at 178.50. So maybe just below there, just in case it goes pear-shaped with the results. Now I've got another one, B&M. Let's have a look. This one here looks better because we have a very healthy uptrend. We managed to break above the previous resistance area and the previous lows here. Here, that is positive. We then had the retest here for Steve, for example, retest of that previous breakout area, held here and went back up again. So all of that is looking short-term pretty positive. If you look at the trend, we can see here we have a nearly 45-degree line probably. We need to take out the 6th of May high for us to continue to go up. The next upside target in that case would be the high going back to January of this year at around 378. So that would be the next upside target. Your stop loss probably has to be a tight one because you can't have the second to last reaction low, which is down here. If you're long, that is, the stop loss would probably be around Monday the 12th low here. Maybe it's just trading sideways. We'll have to see. As long as that Monday the 12th low holds, we seem to be pointing upwards again, and we could continue to advance on this chart here. Now I've got another question. I've got lots of questions today. You want me to look at all of your markets. Now, obviously, you do realize that I'm just looking at these charts very quickly, so I haven't done a proper technical analysis on these, and I'm not giving trading advice. But out of all the ones we've just looked at, Rank Group is actually my favorite because we can see here we've had a very nice uptrend. We've had this bottoming formation here. As I showed you before on the other ones, we managed to break above these previous highs, went above there, retested these previous highs as support, they held, did so again, they held, and then we went up. Then we accelerated to the upside, had this big down move, but you can see that's an A, B, C Elliott wave correction, and then continued to go higher with a series of higher highs and higher lows, and we're just making a new high again above this previous high. That is bullish price behavior. So how far can we go? Well, if you go to the monthly chart, because I always like to look at the longest chart possible, well, we haven't got data on this one, and on the weekly chart, we haven't got data either. So trading at all-time highs, I guess. And here we are looking quite bullish. So what's the next upside target? Probably round number, 6,500 or so. What we could also do is, for example, do a Fibonacci extension in this case. When you have new all-time highs and you don't know how far the market can go, you can do a Fibonacci extension. So what you do, you take the lowest point of your chart where a move started, this one here, for example, and then you take it to the first reaction, and then you collect it to the last reaction low, so reaction high to the reaction low, and see how far that takes you. So, for example, you could have taken this distance here, projected that upwards to this distance there. So that would have been your first, these would have been your targets. Now, these have all been reached. We want to see what happens in the future. So what we can do is we can say, well, actually, let's just take the Fibonacci extension from the lowest point, which is this one here, connected up to the highest point we had in an up move, and then the next big downside correction here. And then from that point there, we project upwards the next upside target. So you can see that move here from there, up there, down to the reaction low, back up again. And that gives me 100%, so the same distance from there to there extension, which comes in at 6,334, just above our, below our 6,500 target. And then the big one, longer term, would be the 161.8 Fibonacci extension. That's at 8,318. So that's how you can find targets. It doesn't tell you when these targets get hit, but they do tend to get hit usually at some stage in the future. Now, I've got another question to do with cable. Is cable a good one to buy on the pullback over the trend line? Well, ideally, you could buy it if you're happy to miss it potentially. You could buy it on the retracement to the trend line. Makes total sense. Ideally, that's what I would like to do. Now, ideally, what you do is you this morning you would have gone long here on the break above last Friday's high at 133.33. Because that was also where the trend line was. So you had a trend line break and a break above the previous reaction high, and you go long there. But if we see a retracement back down here again, then yes, you would probably go long on that retracement. If it retraces back into this sideways trading area, you could still also go long if it were to happen. The only problem might be that because of the downgrade we saw on Friday with regards to the US debt, by Moody's from AAA to AA1, it is possible that the current dollar weakness, which is driving this strength in British pound against the US dollar, might not reverse and become dollar strength again. So you might not get the opportunity to get into this trade. It might just run away from us. But yes, you could wait for a retracement. And in that case, your stop loss would be smaller because basically your stop would still be down here. And thereby we would have a smaller distance to the stop than we do at presently here. Right. I wanted to show you something else. You know, about the Fibonacci extensions. I said a few weeks ago that I've got to talk about these a bit more detail. So here, for example, you've got the DAX. Can you see here the DAX 40 contract? This is a weekly chart. And what I did here is I took the distance from the March 2020 COVID low to the high, which was made back in January 2022, and then took that distance and projected it higher from the low seen in October 2022, from that bear market low. And that gave us the upside target, which we currently still have, which is 25,283. That's 161.8 times the distance of the previous up move. So that's how you can create these upside targets. If you do the same on the FTSE, let's just do it on the weekly chart. So here, for example, what we could have done, we could have said, well, okay, let's do a Fibonacci extension. So we do it from the lowest point here in 2020. We go up to the highest point before a correction. Now, you could do this one if you wanted to, because you can see where the sideways trading range, we went down here and then we went back up again. Or you could take that one and then just see these lows. Let's just, I mean, you can have lots of different ones, but let's just take this one as an example. To the highest point, down to the lowest point here, this one here, and that gives me an upside target, a long-term upside target, which comes in, sorry, let's just do this very quickly again. From the lowest point to the highest point, projected upwards from the lowest point, and that gives me 161.8 Fibonacci at 11,513. As I said to you, it doesn't say when that gets hit, so it might be, you know, in 30, 40 years' time. But we have 100% extension here at 9,676, so that could be an upside target. But you can see here that the FTSE quite often takes years to move and just move sideways, etc. These targets are much less likely to be hit than the one I just showed you with regards to the very strong DAX index, the German DAX index. And you can see here on the weekly chart that we've had 6 consecutive weeks of gains. And this week we'll have to see whether maybe we will keel out in the short term and lose some upside momentum because we made this doji formation last week. And this brings me back to US markets, and you can see we've now entered this resistance area here, and perhaps we may come off in the short term, retest these previous lows here, which may be support. Perhaps we might lose some upside momentum in the course of this week. We'll have to see. Right, I don't think I've got any more questions. So thank you very much for watching Technically Speaking with me today, and I hope to see you again next week. Goodbye.
And we are back, and no, your eyes do not deceive you. This is a whole other cast. It's a whole other day. It's a whole other show. It's still called Overtime, though. I'm Ilias Pivac in San Francisco. That's Thomas Westwater, and sorry, Thomas, and Mike Butler there in Chicago, with a very special view on what's going to happen in these markets now that today has passed and given us all kinds of confusing things. Gentlemen, how goes it?
It's going well. Markets are just churning, it feels like. But it's delivering us into the weekend. So who are we to complain?
Help me to understand what happened here today, because as macro nerds go, I was reading the slew of economic data that came out today, and there was a lot that there was to chew on here. What stood out to you guys, and why do you think the markets ultimately didn't care about this flood of information?
I think
at least as far as stocks go, I should say.
So the retail sales came in, they were light. It affected the market a bit. You also had the PPI in there. The home sales were weak. But I think this was something that was already priced in. We knew that the impact of tariffs was going to have some effect on consumer spending. We saw imports get pulled forward, and then we get this retail sales data. It's slightly soft, so that's reflecting the consumer more than manufacturers. So you're seeing that, consumers are a little weary to spend right now. But I think that the market is expecting these talks to go well, that we're on a path of resolution now, and that now in the future, the expectations are that this spending is going to return. We're going to get some uplift in the economy, pending that these talks go well. We have the 90-day pause on the China-US tariffs, the rate's down to 10%, whatever it is from China. 30%, something like that. So I think the market is still looking for optimism where it can, and absent a negative headline outside of economic data, if we get a headline that says, trade talks deteriorate, China, tells the US to go, walk off into the woods, then it would impact the market more. But I'm putting walk off into the woods. There's other phrases you could say, but I think that's what's going on.
Walk off into the woods is a new one that I've heard.
Yeah,
but it
I like it.
It gets the point across.
As I was
right.
As I was sitting there waiting for where Thomas was going to go with that, I'm like, okay, this is going to be poetic, and it did not disappoint. Well played.
We want the FTC on us.
That's right. This is sort of where this becomes very interesting for me, because if you look at where we're sitting as far as the S&P here as just a kind of barometer of overall risk sentiment, This is the direct underside of this range where we were consolidating going into the beginning of the year and sort of waiting for what the policy wins would ultimately give us. Obviously, we did not freak out back here when the election actually occurs around the idea that there's tariffs and there's this and there's that. The markets don't actually freak out on that then, ostensibly because they go, you know what? Conceptually, this isn't scary. Let's see what it looks like in practice. And then in practice is where we see the growth fears begin to emerge. Here, this is as the business confidence and consumer confidence data starts to roll off negative. Then, of course, we have whatever last month was, this kind of idea that in the U.S., we're going to do our absolute utmost to cut our nose off and to spite our face and basically attempt to extricate dollars and treasuries out of the foundation of the global financial system. So sort of like dig a tunnel for the foundation of the house to leave and leave everything else just hoping to stand. Obviously, that freak out has now passed, but we are basically back to the starting line here, where the demarcation point is for we're afraid about growth or we're not afraid about growth. So it's a very interesting spot. And the thing that jumped out at me today was this move in the bonds. And this was across the curve today. I mean, obviously, we're looking at ZB here, but ZN rallied, ZT rallied, interest rates were lower across the board. Does that tell you anything here?
I think, the PPI data, the retail sales data, it boosted the Fed cut bets a little bit. If you're looking at market trackers like the countdown to FOMC. So a slight, strengthening in rate cut bets, pushing yields down. The move in yields is a little more than I would expect. Just on that data alone. So I don't think that fully explains it. I'm not sure what exactly is happening there, but a pretty significant move in yields today. Yeah.
So as I was reading this data and sort of trying to figure out what happened, and Mike, I'd love to hear what you're seeing here from your vantage point, but the thing that jumped out at me was that you had this massive move lower in yields. I mean, we can see it here, and we can see how it happens basically in line with where this data starts to occur. The data appears right around here. The markets take a little bit of a second to digest it, and then yields go screaming lower and bonds go up. So the interesting part of this was that Fed policy odds in their aggregate, so this year and next, actually came in a little. But how much easing was priced in for this year increased. So the market's really cemented around 50 basis points for this year, which they weren't quite so sure about yesterday, but they wound back a little bit from next year, which is interesting. Now we're only looking at 30 basis points for next year instead of another full 50. So it's a curious sort of mix where the markets seem to go, they'll need to cut sooner, but maybe not so much. Powell also spoke today, and it wasn't really a policy speech. It was more like academic, long-form thinking, but they're revising their framework, and they'll have a new one for next year, ostensibly, and by the end of the year, we'll know what the update is. But the progress report was they're probably going to jettison average inflation targeting. So this idea that they came up with 5 years ago that they're going to allow for inflation to overshoot or undershoot if it is following a period of the opposite. So if inflation is structurally too low for a long time relative to target, they'll let it overshoot for a while. And if it's too high, they'll let it undershoot for a while. They seem to be saying policy is going to have to be more reactive and more fast acting. And we're not going to tolerate deviations as much. We're walking that idea back. So they're seemingly setting themselves up for a situation where they're not going to perhaps cut as quickly if inflation is sticky here. And so despite all of that, yields come in sharply, and Fed policy odds move to sooner cuts, not later. So I thought that was a bit curious.
Yeah, I think
Mike, what are you seeing out here?
Yeah, it's interesting when you have well, first of all, the E-mini S&P futures have gone up every day except for 3 days since April 22nd, almost a month straight of just green bars. And yet there is still a lot of uncertainty under the hood, like we're talking about. But I've been keeping my eye on the FedWatch tool, and almost exactly like you said, 2 weeks ago through December, or through the December decision, there was a 75 basis point cut priced in. Now they've taken that out and they've moved it to a 50 basis point cut being priced in by a much larger probability. It was 30%, 30%. Now it's almost 40% for a 50 basis point and 30% for 75 basis point. But to your point, the June decision was significantly higher of a percentage to stay where we're at 425, 450. And now they're pricing in a larger probability of getting a 25 basis point cut in June. But if that doesn't happen, it's much more probable that we get that 25 basis point cut in September. So literally, like you said, the probabilities have shifted almost exactly to your point. And I think that's why you're seeing a recovery in the E-minis, which I feel like is natural given the decisions and the discussions that are being had. But there is still plenty of volatility in the interest rate environment.
It's an interesting thing because, and I'm going to nerd out here for a second, so apologies ahead of time. But if you look at the internals of these reports today, let's take retail sales first. Obviously, people were expecting a slowdown. They were expecting a flat number. They got 0.1%. So at face value, it was even a little bit better than expected. But the real interesting thing is what happens from March to April. In March, we had this giant revised 1.7% surge, which is a lot for a given month. And when you look at what happened there, it was almost completely driven by an almost 5% rise in motor vehicles and auto parts. And of course, it lines up with when those tariffs come out. So you get the sense that consumers are trying to front run the auto tariffs, basically buy as much as they can before those happen. But what do we have in April? We have Liberation Day. Everybody freaks out. Then a few days later, the president says, well, good news. Here's a 90-day front-loading window before the worst of this goes into effect. So you'd think consumers that were minded to front-run tariffs would front-run tariffs because they were just spooked with these large numbers, and now they've been given a mulligan, essentially, to say, go buy stuff that's not so expensive. Here's a 90-day window because now you know what's coming. Okay. They don't front load, though. Retail sales don't go up. So what's going on with consumers here? Okay, let's take that thought and take it over to the PPI report. Here, we have the first month-on-month decline in wholesale inflation in a few years, and the largest one since COVID. So you go, okay, what's going on here? And it's not the goods side. It's not like the price of goods fell. Obviously, with tariffs, you wouldn't expect that. It didn't rise a lot either, so perhaps that's still in the pipeline. But the real story was the decline on the services side of inflation because margins shrank by 1.6% for costs related to basically running the supply chain. So costs of shipping, cost of warehousing, cost of getting things from port to store, essentially. And that tells you that businesses are eating rising input costs. They're not passing them on to consumers, which helps to explain the relatively normal CPI report earlier this week, and also seems to suggest, well, if consumers are being insulated, why in the world aren't they stockpiling and front running since they know what's coming? So it paints you a story of consumers that are reluctant and could be more so were businesses not shielding them. And it also makes you think that all of the import surge and inventory build in the first quarter GDP numbers, which obviously skewed that report a lot. That might be stuff that sits in warehouses if consumers don't want to buy it. And then it's going to end up looking like a bad investment. So in a year when everybody has to roll over their 5-year COVID money that they borrowed at zero and now have to refi basically this year and next. So you crown all of this off with jobless claims numbers that give you the highest 4-week average since October. And you go, okay, wait. So companies that are eating input costs instead of passing them on to consumers, they're probably not going to be enthusiastic about hiring. And then consumers don't get the hiring, so they don't consume. And if they don't consume, then you need to eat their costs more. And you get a kind of vicious spiral here. So you already got the weakest contribution from household consumption in almost 2 years in the first quarter. What happens when that occurs in the second quarter? Or worse, let's say. So that's where my head is going here. And obviously stock markets don't really care because it seems like they embrace this idea that sooner rate cuts are coming and maybe there's a kind of balance there. But bond market seems to have gotten a little bit of energy behind it, thinking, there's something that's brewing sooner than we thought. The Fed's going to need to wake up here.
Yeah, I think those are all good points. And if you're a retailer or business and you expect the tariffs to be short-lived, you don't want to raise your prices because all you're going to do is lose market share. So if you stomach it for a while, you eat those margin costs for a little bit, and you expect the tariffs to be, taken off, you're going to do that. But at the same time, consumers are pulling back on their spending, so that hurts the margins even more. So if the tariffs go awry with these talks and they go on longer than, say, the 90-day pause, then I think you could bring the recession fears back onto the table. I think right now what investors are expecting is just some moderation in growth, a little bit of sluggish growth for 2, maybe 3 quarters, and then we get back on track. I think with the market being forward-looking, it's why sell here, especially if the Fed is going to come in and gently cut rates, get us back on path. Trade gets back on path, everything like that. And then all of a sudden, you're past the rain clouds that have formed. So I think it makes sense that, we're still moving higher. The economic data definitely hit the markets early in the day, but you saw it was digested quite well. There was obviously no shock to the market. For the bond market, that's my thing too. That's why I'm wondering why yields have dropped so much. And it's also another thing you have to bring up is Congress is going through another tax bill right now. So bond traders are watching how that's developing quite closely. Now, if you do tax cuts and you have no way to pay for them, if you're not the U.S., that's led to catastrophe before. We look at 2 years ago in the United Kingdom, Liz Truss, the whole lettuce thing.
The lettuce thing.
Yeah. Earlier this year, you had people calling for, the de-dollarization is finally here. The global regime is changing. But, it looks like this tax plan is going to move forward with tax cuts without, subsequent one-for-one funding. I think that's pretty positive thing for the bond market. It shows you, pretty objectively that we are not actually at that point where you are getting, this shift away from the U.S. as an actual safe haven. So I think that's pretty notable there. I'm not sure it explains the move today, but that's just something to consider in the backdrop.
Mm-hmm. And I think when you look at the cyclicality of the E-minis, the NASDAQ, like any kind of equity space, obviously markets are moving way faster than they did many years ago. So you're going to have these kind of knee-jerk reactions to the downside and in recovery mode to the upside. It is still surprising to me that we've recovered this much. I would have been less surprised if we kind of chopped around that 5,500, 5,600 level. But we could easily get back there if something comes off the table like we're talking about. So from a tradability standpoint, there's still plenty of products out there that have been beaten up that if you wanted to buy and get long, you could at much lower levels. But from a downside perspective, volatility is as low as it's been in the past couple of months. We went from backwardation to contango. There's over a point of contango now between the K and M contract. So if you're looking for near-term hedges or even just hedges in the equity markets to play for something falling out of it from a relationship or talk standpoint, it's now cheaper than ever to do that as well. So it's very tradable still. We've had this period of calm the last couple of days, but even though volatility is back in the teens, I think you'll still get some spikes in volatility. You'll still see two-sided action because let's not forget what we're dealing with. We're dealing with very volatile situations where things can fall out of bed very quickly. And if they do, the markets are going to react that way. But right now, to Thomas's point and yours too, Leah, it's like there's still some churn that seems like it's baked in going forward. We're getting a better picture of the interest rate environment with more probabilistic outcomes from what I've seen, because literally the last couple months through this, it's been really baseline. If you look further out on the curve through the end of the year, it's like we might be at 75, we might be at 50, we might be at 25. Now it's starting to form this narrative of we're probably going to be at this point, and it's growing in probability, which speaks to the bonds and rates. But from a tradability standpoint, you can still do a lot of things here. Even if you don't believe that the equity market's going to sustain, you now have a very cheap way to play to the downside at higher prices.
Yeah,
that is certainly it. If you want to take the kind of exposure, which admittedly I took way too early, and just straight up buy put verticals, it is the cheapest that it's been. Certainly in sort of the recent weeks.
Yeah, and why not do that at least as part of your portfolio, so when you do get those red days, you're at least insulated. Even if you're playing a bullish thesis, you have a hedge in there, here and there, and you can do that tactically. I mean,
absolutely.
But you look at the
things like SPY, things like the Qs, things like IWM, although that one's a little bit thinner. They give you smaller sizes and cheaper costs than, let's say, even MES or MNQ. So you could find some very cheap hedging opportunities here. To your point, Thomas.
Yeah, and I think IWM is probably one of the better ones to do it on, because if you get these trade fears coming back into the market, it's the smaller companies that don't have these margins to outlast a prolonged trade war. So I think it's a really smart move to play if you are doing those, buying put spreads, especially as a hedge against a more bullish portfolio, to do that on IWM.
One thing to keep in mind about IWM that I learned recently is to just stick to the tasty methodology and roll over your positions once you get to let's say 20-21 days to expiration, because liquidity starts to really dry up as you get closer to expiration. For example, I have a part of my vertical that I was trying to roll with about 5 days left, and for some of it there was just no bid, and so now it's just a thing that sits. And I mean, obviously you can essentially assume it's going to expire, worthless trade around it if you have capital to just sort of put on what you want to have on and then let that thing just kind of sit in inventory and fall away. But if you don't have that kind of capital, or if you've committed it elsewhere, it can hamper you a little bit if you start to kind of press it closer to expiration because liquidity in this thing is a little bit thinner than, let's say, SPY.
Yeah, and one other thing in the market today, we had a big move down in crude oil.
What a segue, Thomas. I was just about to ask you.
Yeah, so I mean, this one's interesting because you have the U.S.-Iran talks going on, which the market is really focused on. Trump just had a visit to the Middle East. There's a lot of players on the table mediating these negotiations now. Iran's producing around 3.1 to 3.5 million barrels per day, depending on the source you look at. The interesting thing is they really don't have that much capacity to increase production more in the short run if these tariffs are lifted. So I'm wondering if the market is overconfident in how this will actually affect the global supply of crude oil. That being said, now you have OPEC very inclined to keep on rolling back these voluntary production cuts. You could say they're doing it for multiple reasons. Better U.S. relations with the U.S. right now, try to punish U.S. producers, get Kazakhstan and Russia, Iraq back into, enforcing their quotas. They do it through that. They've done it before that way. So there's multiple reasons. Another reason is they just want to eat the pain right now and finally take these voluntary rollbacks off the table. It has to be done at some point. Why not now? That's probably just as viable of a reason as any other reason. But the fact is they're doing it. They're going to, from all signs, it looks like they're going to continue to do it right now out into June, July, August, most likely. So, oil trading just above 61 right now. We got back above near the 64 mark. We were all the way down as far as 55 just earlier this month. So, you've had a good amount of volatility in the oil market. I churned my position into pretty much an iron condor today. I'm 56, 58, and 63, 5, 64 at 32 days out. It's getting to the point where I'm going to take it off soon. I'm going to give it another week, see how I think we're getting to the point in these negotiations where you're going to get more material substance over the next week. And while I said that it probably ultimately doesn't impact the oil market that much right now, it seems like that's what the market is focused on, is these negotiations. So I don't know. You also had the EIA. They reported a surprise withdrawal in inventory or build in inventories yesterday. So, we have supply building. You have crack spreads that are still strong. You have refinery utilization rates that are strong, but not as high as where they've been. So refiners seem reluctant to pull back on moving crude oil through right now, even with some fear among traders. They're still moving the oil into products. So it still seems like the oil market is going to remain somewhat strong over the short term. What does that mean in terms of trading? I think we remain above 60 for a bit. I don't know if we get back into the 70s necessarily. I think a lot of this economic moderation is going to kind of kneecap that, along with more OPEC supply. So I think you get to these points where you take advantage of the volatility, you try to pick a range, and whether that's selling a put spread, selling a call spread, if you think that range isn't going to be broken, or putting on an iron condor if you're more confident in that. I think that's probably the way to play it right now. And if you look at the technicals, you have pretty good levels to carve out, technical ranges that you can trade around.
Yeah, crude has been a darling for many years. We've talked about this before, but it's nice when you have a product that is truly a two-sided vehicle, where you have shifts higher, you have shifts lower immediately after. And we've seen that from the beginning of April. We've had a range between 65 and 55, 10-point range, both sides. If you were short, you had opportunities to get out. If you were long, you had opportunities to get out. So we're almost always in crude, micro crude specifically for me. I like just buying the contract straight up. I have a covered call on right now with the long contract and a short call at 65. So kind of just taking advantage of the IV in that range and seeing if we get a bounce here. But yeah, it's been a great trading vehicle, especially the micro, where you can get much smaller than the bigger contract.
It's an interesting thing because technically you look at this and you go, okay, so you have a situation obviously where OPEC starts to give you this idea, oh, we're going to get rid of these voluntary output cuts, we're going to boost production. And Thomas, obviously, what you're describing here is exactly it. They want this friendly relationship with the U.S. They obviously understand that the administration has a different perspective now. The president is in fact there currently, and so you have this sense that, okay, this is the time to do this. If ever we could negotiate for a security blanket, especially if you're Saudi, this is it. And so you have that gap, and then the market goes, yeah, but you guys never follow through. You guys never manage to have the kind of discipline that you need to get your membership to actually meet output quotas. In fact, these guys haven't met their output quota since they developed output quotas in 2014 for the whole outfit, the OPEC plus outfit. So the cartel and its friends, as it were. So the market looks at this and goes, yeah, okay, right, sure. Whatever. And then oil goes up and runs into this 64 level, which we can see is a very clear kind of middle axis in whatever this range is, from 71 to on the top side to like 54 and change, 55 on the bottom. So we come off there, and the thing that grabbed my attention today was, if you look at, I have an 8-hour chart here. If you look at the sort of architecture of this rise, right? Higher high, higher high, higher low, uptrend classics. You break through it right here. Now, it's very preliminary, very kind of early to say, and I didn't act on it today, but it gives you the sense that maybe you're in for what is the next oscillation in this. And directionally, it's not the greatest at 48 IV to be buying put verticals, but it's also not very expensive, especially if you look at something like, let's say, USO, which is very, very cheap. So when you look at this and you go, well, are we going to get maybe a wiggle in this direction now? Maybe around some of these negotiations that are taking place in the Middle East. Maybe the headlines give you enough. It's still probably going to be something that's going to have to be a real commitment from Saudi by themselves, maybe with some assorted help from the Emirates, maybe some other like very Saudi close places where there could be consensus. I guess you could also, Thomas, to your point, get some sort of an Iran walk back and some of that supply coming back on. Would it matter? Probably not. But it could give you a shorter term wiggle within this range. Do I think that's going to give you a breakdown lower? For all the reasons that you've just outlined, Thomas, probably not. But headline-wise, there could be not so much an investment, not so much a set it and forget it kind of a thing, but maybe just a trade to look back toward the downside. And the kind of signs of weakening consumption that we saw earlier today, they sort of comport if that becomes the focus, because we have consumer confidence numbers that are coming out here to kind of finish the data outlay for the week. And they're expected to be absolutely awful. They've been absolutely awful, and they're expected to stay absolutely awful. The inflation expectation component has been the main reason, obviously, around the tariff fears. 6.5% was the 1-year inflation expectation in the last version of this report for April, and now we're going to get the sort of first look at the May edition. If everything that we're seeing in the PPI today, the retail sales today, if all of that gives you a defensive consumer, and you know you already had a defensive consumer in the first quarter, now it starts to look like you're getting a defensive consumer into the second quarter. And the consumer confidence data would give you the first kind of real look at May, sort of as it's happening. Then you'll get the PMIs later, and sort of the picture will start to crystallize. By the way, the latest PMI numbers, absolutely awful, showing the U.S. economy is basically stopped. It's basically at a standstill. Like once you peel away all of the distortions from imports and inventory building, actual new economic activity, whether you look at the ISM or S&P Global, has basically stalled. And obviously the big question is, now that you've had a 90-day kicking of the can on both the reciprocal tariffs and the China tariffs, so now you have cliffhangers in July and August, you'd think, okay, well, probably you get more front running because businesses just got another window to do what they did in the first quarter. But then if consumers don't buy it, this imbalance starts to get exacerbated. And now you're really setting yourself up for recession classic. Overcapacity, disinflation, discounting, job losses, falling consumption, sort of very, very kind of regular business cycle stuff. Not a crisis, not anything spooky like 2008 or COVID or anything like this. Just a regular old recession. And of course, the trouble with those things is that those things are non-linear. You never quite know what a recession might kick up. Because as long as there's growth, you paper over all kinds of things. If people are confident that there's money to make tomorrow, though you might have lost it today, things are going to be okay. Confidence will hold up. But if they're not, if the growth part of the story falls away, well then maybe tomorrow money isn't on the table as readily and things get defensive. What's interesting about crude oil in this context is you get some chatter about maybe increased supply and maybe the markets even believe it for a while. If you then with that get a growth spook, this could be telling you that crude is at the very least interested in revisiting the bottom of this range before maybe whatever else. And I'm curious how all of this comports for you guys when you think of the dollar, because this thing has been very weird. If you look at the overall index here, obviously it's not really going anywhere. But if you start to pull apart the internals, say you look at the euro, and you can see here the euro really doesn't do much of anything here the past several days. But if you look at the yen, which is a much more bonds kind of facing thing, as bonds start to go up and as yields come in, so too does the yen. It starts to go higher, which again is sort of recession-y in its look. Last thing I'll say here, and I'm curious to your thoughts, the sectoral breakdown today, very interesting. The only S&P 500 sector that is down today is, drumroll, consumer discretionary, which really fits into what we're talking about here. Consumer staples, on the other hand, up, which is defensive. Utilities up. Real estate up because ostensibly lower rates and rate cuts are maybe finally going to help unlock the housing market. But the only red on the board today, consumer discretionary. Thoughts?
I think Tesla hit the discretionaries today. I'm not sure if Tesla was the cause or just got dragged into it, but it's heavyweight on discretionaries. I think, yeah, it's with the margins and the PPI data retail sales showing that there's less spending. So if you're a consumer and you're trying to tighten up your balance sheet for your household, you are pulling back on that discretionary spending. And you consumers, the staples have to stay strong because they're staples. You have to have them. I mean, I don't think it gets more complex than that, really. I think that's a simple explanation.
Yeah.
That's
Trying to tell me people aren't going nuts buying Royal Caribbean cruise tickets right now?
I mean, if you look at the data if you look into the data this morning, hotels and flights were actually really weak. So,
Yeah.
I mean, it's maybe a good
Absolutely.
time to bargain hunt on those getaways.
Yeah. I mean, I can see it. It makes sense that people would be weary after enduring what we just endured, right? It's kind of like everybody got the shock and the big move down in the equity markets that most people are passively long. If you have any kind of retirement account, you're likely affected by that. And now you are kind of maybe a little freaked out. You want to wait and see, take the wait and see approach versus just diving in head first. Makes total sense. I would be remiss if we didn't talk about gold, though, on behalf of Chris Vecchio.
We do have to talk about gold
because this is a big intraday move today too.
And it does have to be on behalf of Chris Vecchio because I ran away from my long position earlier this week as we broke down this band right here. So I essentially jumped on right around here, basically on the same logic that Chris had, that this was this, and that you're just stair-stepping up. So you had a rally. Here was your level. You rallied. You corrected. Stair-step, higher. Pullback, stair-step, higher. It worked for a hot 2 days here. And once it took out the stair-step back on the downside, I was out. But what a reversal here today.
Yeah, getting back above 3,200 is what stopped me from selling my call spread in GC. So I kept that on, still in a little pain there, but I don't know. I'm really conflicted on gold. Obviously, earlier this year, very bullish. Technically, we have dissolved a lot of the strength, but I think moving under 3,000 would be a lot more concerning. If we could hold 3,200 and this early April swing high, I think we could reestablish a trend here.
Yeah, I actually agree. Just as I am sort of, I look at the 8-hour chart in oil and I go, did this thing just roll over? Against all odds, what is this thing saying? Here, I look at the 8-hour chart and I go, did this thing just have a false breakdown? Did it just shake me out of my long position and then come right back in? Damn it. And so as I look at this, it makes me actually want to be a buyer tomorrow because it seems like there's a very, very clear line in the sand here where it comes through and goes, have I broken down? Psych, I have not.
Yeah, it's a chart where it brings up the conspiracies, and it's not even really a conspiracy that the big players have flushed out the weak players. They've reestablished at better prices, and now we move into that next phase, extending the prior rally. I'm going to hold my position here. I think it's, like I said, my confidence is a little lower, but I'm still going to stay long.
And this has been a vehicle very similar to oil, where recently we've had very volatile moves and two-sided action. So we've been trading diagonal spreads and GLD, still very low IV for what it's been doing. But if you're in the futures market, I really liked the broke-wing butterflies. So into these big rips, I'll sell a broke-wing butterfly above the market, and then if you get the move down, you can remove the risk and have the free shot to the upside on. So that's what I've been kind of trying to do in terms of legging into a position into these rallies that we've seen recently. And luckily, we've seen complete reversal on both of them. both of these sustained week and a half long rallies have both been reversed. These recent ones, at least. So, as long as we have two-sided action, I think you can do a lot of stuff and express your opinion and have opportunities there.
And I mean, the IV here is actually decent at 50 and change. So if you sort of took a broad view and said, here's the top of my range, here's roughly the bottom, so somewhere between, let's call it 3,000 and 3,500, and I'm just looking for it to kind of oscillate broadly, not too far away from those bounds. You have plenty of confusion in the bond market, which is the flip side of this. You could have that here. My sense is that it's a really interesting mix within the dollar today, and that sort of starts to tell you some interesting things. So bonds go higher, gold goes higher, yen goes higher, stocks kind of meander. S&P ultimately resolves higher, but we can see NASDAQ here essentially does nothing. So just stuck. But what I thought was especially interesting, the Aussie ends up looking weak. And so you get this kind of risk on, risk off dynamic out of currencies where the risk part, the Aussie, it doesn't sell off. It's consolidating in a range. It still hasn't even given up April's gains, which, by the way, tells you how weak the U.S. dollar is here. Stocks have absolutely barnstormed higher, but the dollar hasn't unclenched at all. Neither have bonds have completely corrected and sort of shaken off their holy moly moment. But dollar hasn't come back. But the Aussie is weaker today. Yen is stronger. It's almost like we're turning into some sort of a lower growth, lower rates kind of a vibe. And that's extending basically everywhere except equities, where you just have this kind of uneasy, wait, do we like lower rates? Is lower rates good? Do we not like lower rates? Is that bad? Are these lower rates for the right reasons? Maybe the Fed can do what it needs to do if it cuts sooner. And maybe that sort of makes for a shallow and short downturn rather than a longer form one. That's sort of how this starts to look. Unless tomorrow the consumer confidence numbers disappoint, which I think would land on a stock market that's kind of uneasy here. If it was shrugging today off, you'd think it would be rallying. But it didn't seem to know what to make of all of this.
Yeah, it feels like equity markets drift higher for obvious reasons, but there's certainly still turbulence under the hood. That's the gist of it, at least what I'm seeing. But yeah, I feel like this kind of feels like a little bit of a calm week before something happens. And you'll naturally see that when you have calming volatility, lower volumes, like this feels pretty natural. It doesn't mean that everything's over. Like, I would be shocked if we just had 20-point moves to the upside for the rest of the year. It wouldn't make sense that would happen. So just be mindful that this is a calmer period, but things can certainly flip in a day's time.
Yeah. I like the yen because if we get back into a fear-based environment, you think bonds go higher, that's going to drive U.S. yields lower. At the same time, Japan reported good inflation data earlier this week. So that gives the BOJ more ammo to increase rates. So I've put in an order for a call spread on the yen today. It hasn't filled yet, but the yield premium for the 10-year U.S. versus Japan is under 3% again. And ultimately, that yield premium, U.S. versus Japan bond yields, really drives a lot of the price action in the yen. So I think the yen is a pretty good play here. We had a really big uptick in the yield premium in the U.S. versus Japan in early April. We haven't really come under that too much yet, but today could potentially be the start of that.
There's an interesting, and yes, I mean that's absolutely that's absolutely something I agree with, and I'm still holding yen on. So I think there's more, and begrudgingly holding bonds via TLT verticals as well, because it seems like we're finally going to get to go that way. Maybe it's been a while. Let's get to regular recession mode. Stocks and dollar lower, bonds and gold and yen higher. That would be nice. It'd be nice to get back to some level of sense out here. The interesting sort of last thing that jumps out at me is, and Thomas, you wrote about Canadian markets today. If we take a look at the ETF here, we can see very strong upward push today for Canadian shares. What's going on here?
Yeah, I mean, we're up 20% since the April low. That pretty much mirrors the U.S. performance. So, we're trading it like the U.S. and Canadian economy is back into a good trade relationship. At the same time, you have a new government, the Liberal Party. They are set to unveil their economic agenda later this month. I think it's May 26th or something like that. But it just appears to be some confidence broadly. The market's going up, so of course there's correlation there, U.S. Canadian equities, but there seems to be some confidence in this new government for Canada. There seems to be like the market believes a trade deal is going to get hashed out rather quickly here. It's interesting that EWC rose today despite crude oil being down 2% today, because the Canadian stock market is pretty heavily weighted towards crude oil producers and downstream companies. So that was a little interesting, but I think it just speaks to confidence in the backdrop. At the same time, you have Canadian unemployment at 6.9%. So it's not, the market's confident, but there's still risk, of course. I think it just speaks more broadly to trade measures, having more confidence in negotiations, things like that. At the risk of being marked off as a perma bear, we might as well, before we end here, mention the one long-term equity holding that I have on the long side, which is Brazil, and Brazil doesn't do terribly great today, but this is one of those big macro ideas where you seemingly have what was a long-term decline here that has now been overtaken, where we started to set a bottom and break higher. So I bought a 240-day call on this, basically, that expires at the end of the year, with the idea that I'm just going to have this and hold it, because if we are in fact reshoring and all of this fire and fury is more about bringing supply chains closer to home, boxing out China and ending up with more regional trade, which is the kind of thing that you would expect coming out of that conversation you just had, Thomas, about Canada, that ultimately the idea isn't to break the link, much like the transition from NAFTA to the USMCA was about more free trade, not less, ultimately. It ended up being exactly the same as NAFTA, just expanded the number of goods covered to digital markets. That all of this is probably good for Latin American markets and countries. And so the place I am long equities of all places is here.
I like it.
With that, overtime is out of time. We could keep going here for a while, but I suppose we'll call it. Thank you, gentlemen, for sitting in. You are, of course, always welcome to to join us and offer your insights. Do come back. We're going to take a really quick break, and then I'll be back to drone on about the macro with copious charts on Macro Money. Don't go anywhere. Stock markets do not know what to make, it seems, of today's onslaught of U.S. economic data, but the bond market is making up its mind. A fire got lit under the bonds today by the economic news flow, it would seem. We're going to unpack what that means and what it might signal for what is happening next, because, of course, we have economic data coming up to cap off the week in less than 24 hours that might put all of this in very sharp relief and tell us a story about U.S. consumers that gets stock markets leerier than they've been in recent weeks. So let's take a look at what's going on here, break it down. Here is the S&P 500. We can see here it is somewhat higher today, but ultimately doesn't make a whole lot of headway, dips lower, ends up a little bit higher, just a touch relative to the highs hit earlier this week. If we take a look at what all of this kind of breaks down to, we get a rise of just 0.4%. Today, in weekly terms, of course, a very strong 4.5% rise. But the close today at 59.34, only a touch higher than the high that we hit just on Monday or on Tuesday, rather, of this week at 59.27. So not quite an inside day today, but not exactly screaming of conviction either. But where things did get very interesting indeed was in the bond market, where we had a broad-based decline in yields and a broad-based rise in bonds. In fact, the largest rise in bonds we've seen in a while. We're looking at the 30-year. Here's the ZB continuous contract, and we can see a very strong up candle here today. That's right there. And this extends across maturity. So we get interest rates lower at the 2-year maturity, at the 10-year, at the 5, at the 30, a broad-based move higher in the bonds and a broad-based move lower in rates across the curve. Still more interesting, the move there registers unevenly in the Fed policy outlook, where on the one hand, we've come down to less of a dovish perspective here than even the Fed itself has argued for since December. We have 80 basis points that are priced in for this year and next, cumulatively. And the changes that happened today on net seem to maintain that perspective. This, of course, has been the normalization we've seen playing out from these panic lows at 137 basis points. This basically follows what we've seen from the stock market. So right here is mid-February, where the market is maybe only anticipating 50 basis points this year and next together. Then we have a situation where the view seems to get worse as economic data weakens, and you see this in stocks. So you get a shift that starts to happen in stock markets right here. That's this move that, of course, we see in the S&P. Not surprisingly, that gives you a dovish adjustment in Fed policy expectations because the spook seems to follow alongside growth concerns. You then exhaust at the April low, the worst of the panic and things start to unclench. And of course, this week, as we continue to recover on stocks, the unclenching continues. But the interesting thing in bond markets today lines up with a cementing probability for 2 rate cuts this year. So while the outlook for next year has meaningfully weakened in the sense that it's become less dovish, the tally for rate cuts next year has significantly wound back. For this year, we've really cemented around the level that the Fed itself has argued for, and the probabilities shifted today. We were only looking at perhaps 47 basis points, or even as low as 44, priced in over the course of the week here so far. We're now at 51 basis points, so we've really cemented that the 2 cuts seem to be coming, whereas for next year, we're at 29 basis points, having been as high as 38. So it seems like about 10 basis points here shifted up in the trajectory. So the markets seem to expect sooner cuts and are surer of their arrival. So what gave us this curious response, and what does it mean? We begin with the retail sales data. This was a very important check-in on the health of U.S. consumers, and what we end up with is an outcome that's slightly better than expected, a 0.1% versus a flat result, which was the consensus forecast, but nevertheless a very steep slowdown from the preceding month's revised higher 1.7% rise, which you can see was the strongest 1-month increase in retail sales since going all the way back here to early 2023, late 2022. So, needless to say, a very significant cool down. And when we look at the internals of the report, they don't necessarily scream positivity. Notice in the red here is the component breakdown for the March numbers. That's last month. In the blue is April. That's the data we saw today. Notice there are no big upside spikes in the blue bars here. And the red bars, that big 1.7% spike, seemingly powered by a 5.5% surge in the motor vehicle category. That's cars and auto parts. And of course, we've talked about this before, and we covered it in detail yesterday. This largely seems to front-run the auto and auto part tariffs introduced by the White House. Now, of course, what did we see in April? The president unveiled so-called Liberation Day reciprocal tariffs, which spooked the bejesus out of markets and obviously showed consumers that the prices for imports across a whole vector of countries is going to be much, much higher. But then on April 9th, after some consternation in the bond market, the president walked it back, at least partially. Said that there's going to be a 90-day pause on rates above a new floor of 10%, which, of course, is already a 5-fold increase relative to an average tariff of 2% before this announcement. And that's this rally right here. So consumers start April with, oh no, much higher tariffs, and the markets reflect this. And then, oh, there's a pause in the worst of this for 90 days. And that cliffhanger now is in early July. China is initially exempt, but after the deal this weekend that gave us this surge right here, we now have a 90-day pause in tariffs above 30% for China. That's a major climb down from the 145% rate before this weekend's apparently friendly talks in Geneva, Switzerland. So we're in a situation then where consumers might have been expected to do another bout of front running because they were just shown scary tariffs and then said, okay, now you get a window to buy whatever you want before these hit. Go ahead. And one might think they would do the same thing they did in March, which is see the higher costs immediately on the horizon and try to buy whatever they can before those hit. They did not do that here, although one would think the narrative encouraged them. Then we get producer price index data. This is wholesale inflation. whereas earlier in the week we saw consumer price index data, that's retail inflation, essentially. And here, what you saw was very surprising indeed. A decline month on month of 0.5%. Now, first of all, that's the first decline since going all the way back here, essentially a year and a half. But the magnitude of this decline is what's really striking. This 0.5% drop is the biggest since back here at the onset of COVID, where supply chains obviously were in full lockdown mode early in the year. So this is telling us a story that's quite interesting. And when we actually get into the breakdown of these numbers, produced helpfully here by Bloomberg, we can very clearly see where the change came from. So here's that 0.5% decline. If we strip away volatile food and energy prices, it is still a negative reading, albeit a more modest one. We can see that goods prices rose, as you might expect in a trade war. But the big turn here happened in services. Services had a dramatic pull down on overall wholesale inflation. And when you look at where that came from, the culprit seems to be a 0.7% decline under the surface, powered by a 1.6% decrease in margin for trade services. Now, what trade services is in this context is the cost of moving goods through the supply chain. So you get the goods into port, or you get them into the factory. You then, once they are in whatever state of doneness that they are, ship them to their next spot, either to be finished or to be sold. So the cost of moving wholesale inventory through the U.S. supply chain, from ports to warehouses to store shelves, that's what the trade services component here is. And of course, the cost of tariffs would appear there. The drop in margins then in that space would suggest that companies are eating higher goods costs and not passing them on to consumers. So here's the goods costs, they're rising. And companies are saying, instead of us passing this on to consumers and maybe driving those consumers away and losing market share, we're going to eat this for a while. We're going to bite the bullet and see what happens next. But what it also means is that consumers were insulated from a good bit of the tariff increase, which, on the one hand, explains how the CPI report this week was so refreshingly normal. For consumers, goods prices, core goods prices, barely budged. All of the inflation was still in services, and there it cooled a little bit, in line with a trend that's been developing for quite a while. Now, what's particularly interesting then is, why didn't consumers front-run incoming tariffs in retail sales? They were being insulated by businesses from the price increases that are already occurring. So why are they so anemic, and why are they so defensive, if in fact they are being shielded, at least for now? Then a third piece of data appears, jobless claims, which tells you that while the changes week on week in initial and continuing claims were not especially different from expectations and didn't really break any ground in trend terms, the 4-week initial jobless claims average, that is new applications for unemployment benefits averaged over a 4-week period, to give you a sort of sense of where the monthly trend is, that jumped to the highest since October of last year. And we can see it's been building steadily since the beginning of the year, suggesting that there are cracks appearing in the labor market. Now, this makes for something of a vicious circle when you put this in context of the other data that you saw today. Weak uptake for labor tells you consumers are going to be defensive. They're probably not going to be as enthusiastic to spend, even when, as we just saw, they got the green light to front-run incoming tariffs, and businesses have shielded them from price increases to goad them to keep consuming. But nevertheless, they pulled back, perhaps because they see what's happening in the labor market and have become belt tighteners in that context. Now, of course, that kind of retrenchment tells businesses they need to keep eating the price increases and pushing them into their own margins. And that, of course, makes them more reluctant to hire, because that's not exactly the time or the position that a business would feel confident about increasing payrolls. And so, to the extent that this dynamic feeds on itself, it creates a negative feedback loop for the entire economy and for consumption writ large, which, of course, is very interesting indeed for a start to the second quarter. We'll see a first look of what it appears to be in the month of May, as we get this update of U.S. consumer confidence data that's incoming here over the next 24 hours. And we can see the expectation is that it holds near these 3-year lows that we hit in April. And largely we can see that this is being driven by this massive surge in 1-year inflation expectations, no doubt reflecting worries about these tariffs. As a matter of fact, we can see consumer confidence was declining from the beginning of 2021 as inflation was heating up. We can see those inflation expectations rising. Then, of course, at the beginning of 2022, the Fed starts cutting rates, so inflation or hiking rates rather, so inflation expectations start to cool. You actually start to see inflation come down. Consumer confidence improves. It peaks as inflation expectations round the bottom. And as we get into now the meat of the trade war, they surge. In fact, they surge so dramatically that they are now above these COVID melt-up highs. And the expectation is that you're not going to get very far away from those things in this most recent survey. And so you start to get the sense that you're getting a weak consumption backdrop in the second quarter. Consumers aren't confident. There's no uptake from them, as even these tariff cliffhangers create an incentive for front loading, and even as businesses act as shock absorbers on tariff cost increases. That, of course, is an ominous sign that consumers are this defensive. Because what we saw in the first quarter GDP numbers was, in fact, the weakest contribution from consumption to the overall GDP pie in close to 2 years. The last time it was that small was the second quarter of 2023. So once you strip away all of this noise, the surge in imports from front-running the tariffs by businesses that are stockpiling inventory, which you see here in the investment component, because they're not shying away from front-running these tariffs. If they can build up big inventories, that's less of a difference that they have to eat for as long as those inventories last, and they have to restock them at the higher tariff rates. So, washing all of this out of the equation, episodic though it is, the bedrock here, consumption, is weak. And if we look at how much each of these components accounts for the total, we can see exports and imports are somewhere down here, sub 20% of the total. And when we net them out, we end up with an overall contribution to GDP somewhere in the vicinity of 4.5%. By contrast, consumption accounts for 68.5% of GDP. So as this goes, everything goes. And the story for the first quarter was weakest consumption in almost 2 years. And the story today, out of the retail sales and PPI and jobless claims numbers, are perhaps weaker consumption again in the second quarter. Tariff impetus or not. And of course, that is a very worrying sign indeed, because already the PMI surveys are telling us that the U.S. economy, which last year was quite buoyant indeed, we can see here, in the PMI numbers. These are, of course, centered around 50, which is neutral. Above 50 is growth. Below 50 is contraction. The further above 50 you go, the faster the growth. The further below 50 you go, the faster the contraction. And so you have here the U.S., which was dramatically outperforming last year relative to the other big economies, the Eurozone and China, the other major engines of global growth. So we've talked about extensively before. The three big influences here make up a whopping 58% of global GDP, and the remaining 42% are mainly vendors to the three. And so it's really these three that matter in terms of overall global growth dynamics. We can see they've slowed down to basically hug this 50 line. And while Europe and China were going there and have been this anemic basically since early into the middle of last year, the U.S. was strongly outperforming until at the start of this year. It's now converged back to this standstill zone. And if in fact we're going to see weak consumption out of the U.S. in the second quarter, well then this in fact is telling us a story of a real downturn. Not only in the U.S., but globally. Because if all three of these things are in standstill mode, well then there isn't very much growth to go around. That would, of course, help to explain why today's data created a pullback in yields. It would explain why a sense of urgency emerged in Fed rate cut expectations, even though it hasn't moved out further into the outlook. And as we look at what stocks do next here, especially relative to this consumer confidence data, it starts to raise the question that maybe this growth-based sell-off has room to return here as markets decide whether their resolution of the headline risk has also resolved the economic risk, or if in fact the economic risk is the thing to be worried about now. And that is Macro Money for today. We're here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. That makes this the last show of this week, so Macro Money will be back on Monday. I'm also on Futures Power Hour Mondays and Fridays with Chris Vecchio. I am on with Victor Jones for The Price of Truth on Tuesdays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back next week. Happy trading.
One. What is going on, everybody? Welcome back to Risk and Reward with Gus and E. Volatile days in the market, still heading to higher highs. When will it be over? I don't know, Gus. We got some things to talk about. United Healthcare scandal. Biggest talk, biggest headlines right now. With that underlying, options are still trading right now, but we'll get into all of that here in a moment. Before we do, Gus, what's going on, brother? How we doing? How we holding in there?
Yeah, UNH,
almost the end of the week.
UNH definitely talk of the town. I'm having a great week myself as far as my personal portfolio is concerned. Just been taking exits, slowly redeploying some capital in some creative ways where I'm where there's perceived value. So yeah, feeling good as a whole. Big day today for me. kind of just got big right at the end.
Yeah.
TNA took a nice little ripper to the upside there at the end and put some IV into my options to make my P&L on the day look a little bit inflated. But it's that's fine. That's fine.
Yeah, I'll
Never
take
hurts.
it. I'll take it. Yeah.
Yeah, it was like one of those funny situations when you'll see your P&L shoot up $200 because there's one little weird spike in IV, but it just happened to happen on the last second of the day. So now I get to look at it overnight and feel like I'm
that's
great.
That's nice.
Which is fun.
Yeah. Hey, no. Well, you put the position on. I know it was all the long deltas we were talking about on Tuesday, right?
Yeah, I don't think. My Alibaba risk of the week, I got short Alibaba on Tuesday. That was my only short position in my account, which I have now exited half of. I'm still holding the other half, hoping for a max profit. It just continued to work down throughout the day today, so not particularly concerned there. But good day. I'm long everything, and the one thing that went down, I was short.
Know.
So I'll take it.
Yeah. I know. I mean, I know we'll get into the market. We'll get into the platform, do a little bit more of a recap on what's going on. But yeah, I know Nvidia. That was the one that I got short on.